Hi, I think we can get started now. Yeah, we have about 55 participants with us now. So let's just get started. I think the latecomers can join in later. Can everybody hear me loud and clear? Can give me a thumbs up if you can hear me loud and clear. Okay, thank you. Thank you so much. Yeah, so I'm not sure whether you guys are supposed to turn on your videos, but if you want to, that's fine. I mean, that'll be great. Yeah, if not, it's okay as well. But do stay with me for the next couple of hours. Right. So I'm just going to share my slides now while I continue talking. Right. Again, can everyone see my slides? Can we have a thumbs up if you can see it? It should be in a slideshow mode. Can see? Okay. Thank you so much. Right. So, welcome to the GST class of the CPA Australia Taxation module. Right. My name is Nohaiza Zainal. Just call me Haiza, Haizah for short. All right. I think the class today is going to be about 3 hour plus to 4 hour max. I try my very, very best to maybe end slightly earlier so that because it's a Saturday, I think everyone wants to go off and enjoy your weekend. All right. There's quite a lot to cover in this class. But this is meant to be a foundation class, right? So a lot of the things, a lot of the notes, and the topics in your study guide, I won't be covering in the slides, okay, because of time constraints. Obviously, the ones that I'm going to be covering are probably more key or critical topics. And I think for some of the slides you will see, I'll just gloss over. I mean, there are a lot of very fundamental concepts that typically in a day-to-day, you don't have to think very much. Later as I go through, you realize, actually, this kind of thing quite intuitive one. So in most cases, you don't really have to deep dive, right? But, usually, for example, when we look at, very complex arrangement, very new arrangement, then we will fall back to these very, very basic concepts, right? But otherwise, really, I think the focus is for you to have a good overview of when a business makes supplies, depending on whether it's supply of goods or services, where is the supply taking place and so on. How do you charge GST? What GST rate to charge, right? And then on the flip side, is I think very, very core to businesses is, can I claim GST or not on my expenses? Right. And then there are some rules. We are very strict in terms of claiming GST. Right. So there are some rules where businesses have to ensure they meet the condition. Right. Unlike income tax or corporate tax, GST is self-assessment. Right. So it's very important for businesses or GST practitioners to know the rules very well so that each transaction you have, okay, do I charge? What's the correct rate to charge? Right. And then can I claim? What are the documents I need to claim? All right. So GST is self-assessment. Everything the business self-assess, they submit the return to IRAS based on their net amount, right? And then on and off, IRAS will conduct audit, right? We do conduct periodic audits regularly, right, to ensure that businesses get it right. All right. Okay, so let's get started. This will be the rough overview of all the different topics we're going to be covering today. A lot of my focus is going to be on the types of supply, right? And then talking about zero rating, exempt supplies, or scope supplies, right? And then the conditions to claim input tax. All right, and then we'll touch and go a bit on imported services and low value goods. These are recent new changes that were introduced in the past couple of years, including some enhancement made earlier this year. Right, these are very new. The rules are very complex. Right, so I'm not going to go through. I'm just going to give you a flavor of it, but I'm not going to go through in detail. If you want the details, please refer to the study guide. Even the study guide, I think, doesn't really cover some of these rules in a lot of depth. Right. So if let's say you are a practitioner, right, and then you realize that, oh, I have this particular imported service, I don't know whether I need to apply what we call reverse charge, then please go back to the main source is always IRAS website, IRAS e-tax guide, right? That is all the where all the detailed rules are, right? So if let's say you can't find the information in the study guide and all that, go back to IRAS website, e-tax guide. For the purpose of this class and your exam, obviously, you do not need to read IRAS e-tax guides. Right, a lot of the key information you need for the exam will be in the slides, the practice questions, as well as study guide. That will be good enough. All right. All right. So just to give a see how we're going to conduct this class. I think what we'll do is I will pause at maybe the end of at every major topic so that everyone also have a chance to ask questions. But in the meantime, if you have any question or anything I'm going through, please feel free to type in the chat. If you want to, ask a question verbally during the class, it's fine as well. But maybe, you do, you put up your hands lah, right, virtually. All right, so let's just go into a brief overview of Singapore GST system. I think everyone know this. All right, so the GST rate, I think very familiar, right? Everyone know it was 7% last year, it's 8% this year. Next year, it will be 9%. All right, and the GST system started in 1994. All right, at that point in time, it was really a long-term. So the GST system was introduced at that point in time at a very low rate, 3%. The idea was to have a long-term sustainable tax system to generate revenues to meet future expenditure. Right, so at that point in time, 3%, I think, and not many businesses were registered. The collection wasn't very high. All right, over the years now, the GST revenue is a lot higher. I think right now it's the second highest revenue contributor. All right, and the GST system is designed to be broad-based. Right, so basically we collect GST on almost everything, anything you spend, any good services you buy locally. All right, and in a way it's meant to be a broad-based, fairer tax system, right? Because it does not differentiate you by income. Everybody who buy the same goods, will pay the same amount of GST, right? Of course, I mean, on the flip side, it can be said to be a bit more what we call regressive, right? Because for a lower income earner, the amount of tax you pay is higher. It's a higher proportion to your income compared to someone, say, who earn a bit more, right? That is also why, every time there's a GST rate change, there's all these GST rebates and all that being given, right? The GST voucher schemes and all that, right? And they are very targeted to the lower income. All right. And when we design the GST system, it's really meant to be a simple system. Of course, that said, the system has gotten a bit more complex over the past couple of years, right? But when we first started out, it's really meant to be a very simple system, just tax domestic consumption into Singapore and imports of goods into Singapore. All right. Unlike if you're familiar with other countries who implement GST, or in some countries they call VAT, VAT, value added tax. They have many rates for their GST. So certain goods are taxed at different rate. Yeah, but for Singapore GST system, we have a single GST rate, right? So currently the prevailing rate is 8%. So everything that is local is taxed at 8%, right? It's flat. Then we have certain things, what we call zero rated supply, right? Zero rated supply is basically taxed at 0%. Okay, we'll go through all this later. Right? And then we have certain kind of categories of goods and services that are exempted. Exempted means no GST at all. All right, but that's about it for the rate. Okay, so the rate is very simple. All right, it's about, what are the kind of supplies or imports that will be subject to the tax. All right, so next up, we'll go into the fundamental concepts of GST. All right, so these are all the different provisions in the law. It's good for you to know. Right, but I think you are not expected to memorize this. Yeah, no need to memorize. I think it's good for you to know that, okay, certain concepts are in the law and which section in the law refer to it. Right, so the main source of the main legislative source for the GST is the GST Act. Right, so for example, if I say Section 7, it means Section 7 of the GST Act. Yeah, you just Google you can find the GST Act, right? Section 7 of GST Act. All right, at the same time, the GST Act itself, at the bottom, the second half of it is what we call the schedule. All right, so you will have first schedule, second schedule, and so on. But these are all part of the GST Act. All right, so later, for example, I will say fourth schedule. So that's the fourth schedule in the GST Act. Okay, at the same time, we also have what we call a set of GST general regulation. Right, so it's like a companion to the Act. All right, again, you can find it online. It's on IRA's website as well, right? So when I say Regulation 26, so it means where you find it is you go to the GST General Regulation, look under number 26. All right, so that's how you read the different statutes, right? But otherwise, a lot of this is really good for you to know what are the things that's supported by the law. right? Then you realize that a lot of the wordings of the law is very cheap. No, it's really not written for us layman people. It's really meant more for maybe for lawyers and are very seasoned practitioners. All right, so don't worry. Okay, but I think what I'm gonna do is to try to explain to you what actually is the law saying. Right. So first and foremost, Section 7 of the Act. Okay, so it basically says that GST shall be levied on supply of goods and services. Yeah. Yeah. GST shall be levied on the supply of goods and services in Singapore and on importation of goods. Right. So basically, that's what it's been saying. GST is charged either on supply of goods or services in Singapore or import of goods into Singapore. All right. And then we move on to Section 10(2). Right. So Section 10(2) uses the word supply. Okay. So for GST, right, we use the word supply rather than sales. In sales means supply in GST, right? But supply means more than that. All right. So supply basically, right, the Act says supply includes all forms of supply as well as reverse charge supplies. Okay, we'll talk about reverse charge later. All right, but not anything done otherwise than for a consideration. In GIS, what this means is there must be a supply. Supply of what? Supply of goods or supply of service. All right. And then the law also says that if it's not a supply of goods, it's a supply of service. It's either one. Right. So then you may be asking me, isn't this intuitive? No, why do we need to differentiate? What's supply of goods as service? Most of the time it's intuitive. It's very obvious. You supply a physical, tangible good, then it's a supply of goods, right? But there are certain scenarios, for example, say hire purchase versus a rental of goods or operating lease, right? Then you may ask, which one is goods, which one is service? Or are they both the same? The answer is no. Hire purchase, by definition of the law, is considered a supply of goods, right? Because at the end of the hire purchase term, the ownership of the goods will pass, right? So then the owner, right, the hiree will be able to take ownership of the goods. So for hire purchase, it is a supply of goods. On the other hand, a rental or operating lease of the same kind of goods is just a supply of service, right? Because at the end of the term, the owner, the person who rent out, you don't get ownership. You have to return the goods, right? You are just basically paying to use the goods during the rental period. All right, so it's in this kind of scenario where it makes a difference, whether is it a supply of goods or supply of service, right? And why do we need to differentiate? Yeah, because there are certain rules later, as you will see, like place of supply. All right, how do we know whether the supply takes place in Singapore or not? When do we charge GST? The rules are a bit different for goods versus service, right? That is why we need to differentiate. But otherwise, by and large, from a layman angle, what is goods is goods, what is service, right? That's from a layman angle. It's this kind of arrangements that we need to be a bit more careful of. All right, so that's one thing. Okay, there must be a supply. Okay, supply means goods or service. All right, it's not good enough to have a supply. All right, if you must have a supply and you must have a consideration. Okay, I'm just going to skip ahead on consideration. Right. So what's this thing about consideration? Okay, so consideration is basically whatever that is being received in return for the supply of goods or service, right? Typically, it can be payment. All right, so you supply goods, you receive payment, therefore there is a supply for GST purpose. All right, but you can receive payment even though there's nothing being supplied, right? For example, if there's such a scenario, you only receive payment, all right, for whatever reason, there's nothing being supplied. So a mere receipt of payment does not give rise to a GST liability automatically. Okay, so there must be supply, there must be consideration, there must be a link between the two. All right, this is what we call close nexus. Right, there must be a link between the two. All right, okay, but consideration need not always be in money. Right, if there's monetary consideration means payment, yes, okay, that one will trigger the supply if it's linked together. Right, but at the same time, sometimes we can have non-monetary consideration. All right, so take this example of trade-in. Say you want to go and buy a new TV. right? And the new TV costs $1,000, right? At the same time, the store allow you to trade in, right? So say you trade in an old TV of worth $200. So in the end, the cash you pay is only 800, right? Right, because 1,000 minus 200, right? So you only need to fork out $800. Then the question is the consideration 800 or is the consideration 1,000? Okay, for this sale of TV. Any guesses? Okay, just shout it out or type it out in the chat. What's the consideration? Yep. All right, so I see some answers. Yes, 1,000. Correct. Very good. Yes. All right. So the consideration is both monetary and non-monetary. All right. So in this case, the consideration is $1,000. All right. Consideration always includes GST lah. All right. So when we talk about this term consideration, in this case, is $1,000. Is the 800 cash plus 200 from the trade-in of the old TV. All right. All right. And then last point is consideration does not equate to profit. All right, so for GST purpose, it doesn't matter whether is it a profit-making or loss-making transaction. That is irrelevant. No matter what, GST is chargeable as long as the supply takes place with a consideration, right? GST is not a tax on profit, right? Unlike, say, corporate income tax is a tax on the income. All right, so this is what we meant just now, okay? The consideration, right? Just now the consideration was if it's 1,000 inclusive of GST lah, so it's 1,000. But let's say, for example, if consideration the price is 1,000 flat, hasn't include GST, the consideration will be 1,080, right? So either way, consideration always includes GST, right? And then the value of supply is consideration minus the GST amount, right? This is the technical term we use. So for example, when you report in the GST return, right? So GST return, right? I don't know if you guys have seen the GST return before, the GST F5. So say you have box 1, 2, 3. Box 1 is value or standard rated supply. Box 2 is value or zero rated supply, and so on. Okay, when we talk about value of supply, it's referring to the amount without the GST, excluding the GST amount, right? So when we say, okay, for example, if I sell something, all right, in this case, I sell a TV, total with GST is 1,080. All right, that's GST $80, right? So how would I report in the GST return? 1,000, the value of standard rated supply will go into box 1. Right, then the GST amount, which is $80, this is what we call output tax, output GST. Basically, the business have to account to IRAS, pay to IRAS. All right, the $80 will go into box 6. All right, so that's how you report it. Okay, so when we talk about value in the GST return, is excluding GST. All right, and another thing to note is, okay, most of the time, arm's length will just take the actual payment amount, not the actual payment terms, right? But let's say if the transaction happened between connected person, right? So connected person can be a company and its related company, a subsidiary company, all right? Or a company and say the directors of the company. Okay, those are connected persons. Basically, right, this is the arm's length principle. What we are saying is the value of supply cannot be lower than the open market value, right? Meaning, let's say you, for example, the company and its own director, they want to sell at $1. Actually, the goods is worth $100. So that cannot be done. It's up to them if they want to receive $1 payment. It's up to them. But when they account for GST, it must be based on $100, which is the OMV, right? Cannot use $1. Most of the time, we will accept whatever commercial consideration, except for connected person transaction. Obviously, this is for anti-avoidance lah. Okay, can all right. There are also other situations where we invoke OMV lah. OMV is open market value. For example, deemed supplies. We will talk a bit about deemed supplies later. Deemed supply by virtue of the word means by right it's not supply, but the controller, the law says it's a supply. All right. So one example will be when you give free goods, free gifts. All right. Because just now we say, right, for GST to be chargeable, there must be a supply of goods or services. There must be consideration. The two must be linked. right? But sometimes when you give free gifts, there's no consideration. So by right, there will not be GST chargeable. It's outside the scope of charging. But the law will specifically say that for such supplies, we deem it to be a supply, and they still must go and account for GST. Then the question is how to account, because no consideration, right? No payment. So that's where we use OMV, open market value of the goods being supplied via this deemed supply provision. Okay, so we'll go through that again later. So just skip these KIV days. All right, and the last bit here is on prompt payment discount. Right. So for example, sometimes, for example, the transaction is $1,000, right? Then the supplier may say, okay, if you pay within 60 days, you pay 1,000. But if you can pay me earlier, right, within 30 days, I give you 10% discount. Okay, you pay me 900 instead. So then the question is, do you charge GST based on 1,000 or 900? Right? So in this case, when the supplier first issue the invoice, they should issue and charge GST based on $1,000. Why? Because you don't know whether in the end, can the customer fulfill the prompt payment discount, right? So charge based on the full price first. All right, then subsequently, if the customer really can pay within, say, the 30 days, and then you will say you only want to charge, you want to give a 10% discount, right? So if that's the case, then the supplier can issue a credit note to make adjustment and adjust the GST to be applicable only on the $900, right? So meaning they can't do it upfront because you don't know whether the customer will fulfill the terms, right? So we can make adjustments later. So for GST, the typical documentation is for the supply, always issue an invoice first, all right? If it's a taxable supply, if it's a standard rated supply, charged at 8%, they need to issue a full tax invoice with a lot of details that's required in the law. But let's say, for example, if there's a need to make adjustment, then they can always issue a credit note. All right, so we have talked about there must be a supply. All right, and then that's when it'll be within the charging provision. Right, next up, then we look at, does it mean that we impose GST on all supplies? All right, so no. All right, the answer is we only impose GST on supply of goods and services in Singapore. All right, and that is defined in Section 8(1), which also says that tax is charged on any supply of goods and services. Right, so there must be a supply. The supply must be made in Singapore. All right, made in Singapore, this is what we refer to this as the place of supply rules, which differ for goods versus services. Right, so all these concepts we're going to deep dive later, right? These are important concepts, so you need to know. All right, and not only that, the supply must also be made by a taxable person. Right, so who's a taxable person? Basically, it's someone who is GST registered, or let's say, for example, if the business is not registered yet, but then they meet the registration liability, right? That means they must be registered. Then that is a taxable person. So what happened is the person or the business, they must come forward for GST registration, right? And then he becomes a taxable person. He must charge GST. All right. And last but not least, the supply must be made in the course of furtherance of business. This is the business test. If you are familiar with corporate income tax, it's the same business test. Right? If you make a supply in your personal capacity, right, it's outside the scope of GST. Right? So GST is to be charged by a GST registered business for supplies made in the course of furtherance of business. All right. So this is where later we'll talk about the GST registration concept. Who must come forward for registration? Only when you are GST registered, you can charge GST. Right? If you are not GST registered, you cannot charge GST. That is a serious offense of unauthorized GST collection. So that's why we have this requirement that all GST registered business, we give you a GST number. Right? Typically for businesses, for a company, the GST number currently is your UEN number. It's the same thing. But on your invoice, you must still reflect as GST registration number, your UEN. Right? And that's how the consumers like you and me, that's how we know whether the business is registered and whether they can charge GST. All right. So from a consumer angle, if you don't see GST registration number in the receipt, in the invoice, then you have a right to question the business, are you GST registered or not? If they are not registered and they're charging GST, please come and report to IRAS. All right, online on our website, there is also this e-service called View Register of GST Registered Business, right? Basically, you put in the company name or you put in the UN number, then you will be able to tell you whether the business is GST registered or not. All right. Section 8.1 has also been amended to include provision 1A. All right, basically it talks about this 7 schedule supply. This is the reverse charge, the imported service provision. We'll go through briefly later. I'm not going to go through the whole 7 schedule. It's very long, very complex. Right, just need to know that this additional provision is for imported services and low value goods. Okay, then we'll just go through a bit briefly later. All right, so we're going to deep dive into every one of these key concepts. All right, so the first question is, right, so supply of is the supply of goods and services in Singapore. All right, whose liability is it? Right, so GST, the onus to collect and pay GST is always on the GST registered supplier. That's why I say the supplier, the business, they have to be GST registered first. And once they do, they collect GST on their supplies on behalf of the government. All right, and then you collect, and then at the end of the quarter or the month, depending on what is their filing cycle, right, they have to pay back the GST to IRAS. All right, this is what we call output tax. Remember just now I mentioned about the box 6 output tax, right? This is the one, all right? Whatever they collect, they put it in the GST return as output tax payable to IRAS. All right, which is also why we are very, very strict on GST. All right, we typically do not give installment payment. Right, for GST, unlike maybe some of the other taxes, for GST we don't give installment payment because the money that the GST registered supplier collect, right, actually doesn't belong to them. They're collecting only on behalf of the government. They're collecting from consumers, so that money must be rightly channeled back to the government. All right, but let's say then what happens if let's say the supplier say they give credit terms, right? Say supply take place already, issue invoice already, right? But then they give credit terms, so customer haven't made payment. Does it mean that the supplier then or the customer do not want to make payment? Yeah. So does it mean that supplier then no need to pay to us? No, unfortunately, no. All right. The supplier is still liable to account the GST to us. So unfortunately, if the supplier is not able to get the GST from the customer, the supplier will have to account out of pocket. Right, in most cases that should not happen. This is the normal business rule, how you transact. You make sure that your customer can make good the payment. All right, but sometimes most of the time it's more of a timing issue. Right, supplier already issued the invoice for the supply. All right, so based on the time of supply rules, right, basically we say that the supply has taken place and the GST becomes due at the time of supply, which is the earlier of 2 events. Whenever he receive payment, or whenever invoice is issued for the supply, whichever earlier. So if the supplier had issued the invoice, haven't received payment, right? So you say invoice is in the quarter Jan to March, but as at 31st March, still haven't received payment yet. Right? In this case, time of supply already triggered. The supplier still must account the GST in his as output tax in his GST return, right? Even though maybe he received payment in the next quarter. Right, vice versa, right? Sometimes supplier maybe ask for early payment or down payment or deposit, right? So if he receive payment ready, haven't issued invoice yet, maybe invoice it should be issued later, all right? Same thing, okay? If only receive payment in this quarter, still must account to us, okay? So it's whichever earlier. Yeah, I mentioned the reporting already, box 1 and box 6. Right. If you guys have any question, please, because I can't really see you guys. I'm looking at the slides. If you have any questions, please, feel free to just jump in, or put in the chat, yeah. Okay, so we have talked about local supply. Okay, so local supply is really fall back on the time of supply. Invoice received, invoice issued, payment received, whichever earlier. Later, we will touch a bit on the rules pending the GST rate change. The transitional rules are a bit different, right? We don't really look at invoice, so I'll touch on that a bit later. Right. The next limb is on import. Okay, import is more straightforward lah, right? Basically, Section 8.4 is the provision for imports. What basically saying is any import of goods will be subject to GST, and the GST, this is import GST. The GST will be collected by Singapore Customs, right? From the importers at the point of import. Most goods are subject to import GST, except for certain exceptions, right? So for example, if you import, let's say, investment precious metals, okay, investment precious metals, they are exempt supply. If they are supplied locally, they're exempt. Okay, if they're imported, they are also exempt import. All right, so in these cases, there will not be any import GST being collected. Right, then we have various GST schemes as well that allow importers to suspend the GST at the point of import. Right, we also have the import relief order that will allow for suspension of GST. Okay, but otherwise, if the imported goods are subject to GST, the computation is based on CIF value, okay, cost, insurance, and freight, okay, plus customs duty, if any. All right, most goods imported into Singapore are not dutiable. There are only some categories of goods dutiable, for example, petroleum, tobacco, alcohol. Those are the dutiable goods. So if the goods have duty, you need to add the CIF value plus duty, and then GST is levied on the total sum. All right, this is not tax on tax. Okay, one is customs duty, one is GST. All right, so we have an illustration here. So for example, if it's a non-dutiable goods, right, say the CIF value is 50K, right, GST will just be 8% on 50K. All right, but let's say, for example, if this is a dutiable goods, all right, so in this case, you need to add the CIF value and customs duty, right? So then you will have the taxable value, right? Then GST is levied on that. All right. The computation is typically is always done by the importer, the freight forwarder. Okay, it's quite a straightforward computation for import. All right, and then the GST amount will be reflected in the import permit. All right, we do have certain import reliefs that I mentioned where there's no GST levied on the imported goods. For example, I think like maybe most relevant to us as consumers will be for travelers. All right, so generally, if you go say to Malaysia, and then you buy certain goods and then you bring back souvenirs or new goods. It depends. The amount of import relief you're entitled to really depends on how long you spend outside Singapore, right? So you go further, spend longer outside Singapore, at least 48 hours. Okay, you have a relief of $500 per person. So you buy new goods, say in Malaysia, anything below 500, you will not be subject to import GST, right? But if you go say for a short round trip, the import relief is only $100. All right. But let's say, for example, we like to buy things online, right? Right. So for example, say you buy things online and then you say from Shopee, and then you import it in via post, via air freight. In that case, the GST import relief is $400. Right. So anything you import in or you bring in below $400 is not subject to import GST. But all right. So traditionally, it's not subject to import GST. Right? Anything by post or by air, below $400, no import GST. But from this year onwards, some of these suppliers, that means the overseas supplier of the goods, they may be GST registered, okay, under what we call overseas vendor registration regime, right? So if they are GST registered, okay, under the OVR regime, they need to charge GST on the goods. Right, so import GST, remember these are two different limbs, right? Import GST on one hand is not applicable, all right? But at the same time, the supplier, if they are registered, they have to charge GST on the goods, right? These are what we call low value goods. Because a lot of them, they are usually overseas supplier, right? They don't really charge GST like how you see it. It's not like a single line item, right? A lot of times, they will just include the GST amount. That means your goods will just cost a bit more lah. Right, so that's what normally they do under the OVR regime. They may have a fine print there to say includes GST or includes Singapore GST, right? But typically you don't see it as a separate line item. right? So, if you guys never noticed, some of your smaller purchases, some of your this kind of low value goods that you're purchasing, since this year onwards, they would have been a bit more costly because they would have factored in GST. Okay. Okay, so that's for the time of supply and time when import GST is payable. So that's time, okay? Next up, we'll look at the place of supply. Okay, this is where it makes a difference, whether is it a goods or services, right? So for goods, it's very straightforward, right? We just look at where the physical goods are located, right? If the goods are in Singapore, you deliver from Singapore to Singapore, right? Then it's considered to be made in Singapore. There will be GST on it. Okay, maybe I use this diagram to illustrate lah. It's easier, right? So you all follow me lah. Okay. So okay, we're just gonna skip ahead lah. Okay, for example, I look at C to D. Okay, so C to D, right? Okay, so C, A, B, C, D, right? Let's say represent different business or different supplier. So let's say C sells goods to D, and the goods are in Singapore. C deliver the goods locally. Okay, this is a supply in Singapore because the goods are moving in Singapore. And in this case, because it's local, it will be subject to 8% GST. Okay, then let's say, right, the goods, right, from D decides to sell to A. And because A is overseas, D export to A. Okay, so when D goes to A, these are what we call the goods are removed from Singapore. Okay, exported, right, removed from Singapore to overseas. So in this case, under the law, it's still considered to be a supply in Singapore. It's still a taxable supply. So while this green box here, right, supply in Singapore, it means it's still a taxable supply. All right, so these two limbs only, taxable supply, but it can be taxed at 8%, right? That's for the local delivery of the goods, or else it can be taxed at 0%. All right, so exports of goods from D to A, it's still a taxable percent, but the tax rate is 0. So this is what we call zero rated supply. All right. Zero rated supply is a bit different from exempt supplies later that you see, okay? But for now, let's just maintain it. Okay, we have zero rated supply, right? Still considered taxable, right? So now the goods are A. Then A decides to sell the goods to another overseas customer. So A to B, right? They are all overseas. The goods are then being delivered from overseas to overseas, right? Never enter Singapore from A to B, right? So in this case, because the goods are outside Singapore totally, so this is what we call out of scope supply. It's out of scope supply means it's not even within the scope of GST. It's not zero rated. This is out of scope. The supply is not made in Singapore at all. All right. So in this case, again, same thing, no GST. Very similar to zero rated supply, but technically it's considered an out of scope supply. All right. You need to know the differentiation between standard rated, zero rated, out of scope. All right. Very common, people will confuse zero rated and out of scope. All right. So just remember, zero rated means originate from Singapore, right? Then export for goods lah. Okay. Export from Singapore. That one is zero rated. Zero rated is still considered taxable supply. So later, when we talk about GST registration rules, right? And then, it talks about what do you take into account to determine whether you exceed 1 million or not. Okay, you will use the term taxable supply. So for registration liability, you need to count both standard rated and zero rated, right? But you do not count in out of scope, right? Out of scope is excluded totally. All right, so again, remember, zero rated, 0%, tax still taxable. Out of scope means no tax at all. No need, it's not a taxable supply at all. All right, so if it's from outside Singapore to another place outside Singapore, this is also what we call, say, third country sales, totally out of scope. All right, there are some exceptions, which is the low value goods I mentioned earlier, right? Sometimes the goods are entirely outside Singapore, right? But because the supplier are registered under the OVR regime, overseas vendor registration, right? The low value goods could be subject to GST. Okay, we'll talk about that later, right? So just to complete this, so from B to C. So let's say B, overseas supplier, right? Sell the goods to C, right? C is a local customer. C import in the goods, all right? So in this case, assuming they pass the title outside, All right, so B to C, right? The title, the goods pass while the goods are outside Singapore, and then C import in the good. Okay, because C becomes the owner already, right? So C import the goods, C pay the import GST, right? This supply is still considered to be out of scope because the goods are removed to Singapore, right? The destination is Singapore, right? This is still considered out of scope for supply. Remember, GST always have for goods, right? Any cross-border transaction of goods, you have a supply leg, you have an import leg. Okay, for the supply leg, it's still considered out of scope, but still C will still pay import GST. So it's not as if the goods has no GST at all, right? What is applicable is just the import GST, right? Right, Ken, right? Anyone okay? Everyone okay on this? Any questions on place of supply for goods before I move on to services? I count to three. 1, 2, 3. All right. So I'll move on now. If you guys have any question, please type it in. All right. So we've already talked about the place of supply for goods. Right. Then on the flip side, we look at place of supply for services. Right. Like I mentioned, they are different. All right. So that's why it's important for us to differentiate whether is it a supply of goods or services. For services, because there's no tangible, no physical location, what we look at is the belonging status of the supplier. Okay, so place of supply of services is quite complex, compared to place of supply for goods. Goods straightforward, just look at physical movement of the goods. For services, it's very, very complex, and if you only have a, let's say there's only one local company and he's supplying the service in Singapore, then it's very straightforward. Okay, local company, GST registered, supply service in Singapore, confirm must charge GST 8%. Right? But let's say if it's cross-border services, that's where all these complexities will set in. Right? We look at whether the supplier is regarded to be belonging in Singapore by virtue of his business establishment or fixed establishment. Okay, I'm just going to touch quite quickly on this. This one, this concept of BEFE has a lot of case law, right? So for GST purpose, normally when we want to determine the GST treatment, first we look to the law, our own law, our GST Act, our GST regulation, right? And then there are certain things. So for example, the GST Act only talk about this lah, BEFE, you know. Then we sometimes it's not so clear cut whether there's really a BE or FE in Singapore. Right. So what we do then, we look to case law. Case law are actually actual cases that have been discussed and decided in the courts. May not be just Singapore court. We look to other countries as well. Right. Similar GST or VAT establishment. So typically, right, most of our GST Act provisions are modeled after the UK's. So we will usually look to case law from the UK, or now recently we also look to the EU. Right. But, yeah. So though the EU 6 directive provisions are quite different lah. So we basically look at, if the provision is similar in other countries, and this case has gone to the court, are there certain factors or certain principles that the court have, laid out? And then we can use this for our cases as well, right? Singapore do not have a lot of cases, which is why we rely on case laws from other countries. Right. So in the law, in section 15, it talks about the supplier will be treated to belong in Singapore if he has a BE, right? BE is the main seat of the business, right? Where the economic activity is being run. So BE typically, right, any one time, business, right, can only have one BE. All right. So BE is typically, let's say, where the directors gather for board meeting, the HQ lah, the headquarter. All right. But the law also says, right, a branch or agency is also considered to be a business establishment. All right. So BE is quite straightforward. Usually it's the HQ. But let's say he doesn't have a BE, right? We also look at FE. FE is fixed establishment, right? So fixed establishment is more mobile, right? So it's basically saying that it can be anything, like any establishment that has both the technical and human resources necessary to provide or receive the services, okay, on a semi-permanent basis, like 6 months or more. So for example, right, an overseas company, HQ overseas, but then let's say they have a project, they are building something in Singapore and they set up a project office in Singapore. right? This project office not set up at least 6 months or more, got people, got the assets, got everything, and they are running the entire Singapore project from this project office. This project office is a FE, right? And if the services they are providing, okay, is all made through this project office, right? They are charging customers and all that, right? It's all from this project office. Then basically, right, we are saying that even though this is an overseas company, but this company belongs in Singapore for the purpose of the supply of this service, because it has a FE in Singapore, and the FE is the one that is providing the service. So what happens? The services will be subject to GST. If it's more than 1 million, this overseas supplier must be registered for GST in Singapore, right? So GST registration is not confined to whether you are a local supplier or overseas supplier, right? You are local, it's more straightforward, right? If you're a local company, you provide services or goods and services in Singapore, you're more likely to be GST registered, right? However, if you're overseas company, you may be liable for registration as well if you meet certain condition. All right. So for services, this is typically why overseas company are registered, because they have a FE here that's providing services. All right. Usually, if you only have one BE, one FE in whichever country, it's straightforward. Complication is usually when you have multiple BE or FE. Right. So for example, you have a HQ overseas, FE in Singapore, FE in multiple countries. Right. Then the question is, for this supply of service, we need to look at which establishment is then most directly concerned with the supply of services. Right. We don't just say because you have FE in Singapore, right? Definitely you must register. We must also see whether the services are supplied through the FE in Singapore. Right. All right. So with that, right, I would have wrapped up the place of supply rules, time of supply, place of supply. Right. Before I move on to the GST rate, do you guys have any questions? No? Okay, then we'll just move on. All right. So next up, okay, based on the time of supply and the place of supply rules, that's when we determine what is the GST rate applicable. Right. I already mentioned this in brief. Just to summarize, basically there are 4 types of supplies that you need to know, 4 categories. All right. The most straightforward is standard rated. All right. This is the GST at 8%. All right. This is straightforward. Most supplies made in Singapore will be subject to 8% GST. All right. Next up, we have the zero rated supply. All right. So just now we explained zero rated supply using exports of goods. Right. So that's one category where it's zero rated export of goods. The other category is international service, which we will touch on a bit later. All right. This is GST at 0%. Right. So again, I mentioned the first two, standard rated, zero rated, together they form what we call taxable supplies. All right. For GST registration purpose, we will need to add up standard rated and zero rated. Okay, we aggregate the taxable supply, right? So sometimes for GST registration, we will say, what is your taxable turnover? All right, turnover means it's a yearly turnover, right? So we basically, what we need the business to do is sum up your standard rated and zero rated supply for the past calendar year, for the past whole year, right? That will form your taxable turnover to determine whether you exceed 1 million or not. All right. The other implication of taxable or non-taxable supply is a business, once they are GST registered, they can claim GST for the making of taxable supply. All right. So this is the input tax leg, which we'll cover later as well. All right. So basically, right, in GIS, as long as they incur expenses, purchase goods or services to make taxable supply, right, the GST incurred is claimable as input tax. Right? But if let's say the supplies are non-taxable, right? So which is, for example, the third category here, right? We have what we call exempt supply, right? Exempt supply means no GST at all, right? And whether it doesn't matter whether there's so exempt supplies are typically those that take place in Singapore, right? But even if they take place overseas, they are still considered exempt supply, right? So exempt supplies, there are only certain categories. We'll cover them also, right? So we have financial services, residential properties, and so on. All these are what we call exempt supplies. All right, they're exempted from the GST Act, right, for certain policy reasons. But the most important thing to note is, if you incur any GST, to make exempt supplies, the input tax is not claimable. Right? Then we have some partial apportionment rules here and there, but the general principle is input tax for exempt supplies not claimable. Right? That's why it's important to differentiate exempt versus taxable supplies. All right. Out of scope supply as well. All right. Out of scope supply, just now, one example was the third country sales. The goods moving from point A to point B overseas. Those are out of scope supplies. No GST. Right. Another example, if let's say you sell property, you have a property overseas, right? And then you sell the property, that is also out of scope supply. Okay, out of scope supply usually only applies to goods. Right? There are some about services, but not very common. Most of the time, it applies to goods. All right. So there are basically 4 categories of supplies. We are going to deep dive into zero rated exempt. Right, because standard rated is obvious. Out of scope supply, like I said, is mostly goods. In terms of GST reporting, all right, box 1, you will report the value of standard rated supply, the first one. Box 2 is value of zero rated supply, box 2, right? And then box 3 is exempt supply, value of exempt supply, right? So for GST reporting, businesses are only required to report 1, 2, and 3, right? Out of scope supply do not need to be reported in the GST return. Can Okay, before we go into the different types of supply, I just want to mention briefly about the transitional rules for GST rate change. Okay, again, this is very there's many rules depending on the different business scenarios. We won't go through all, right? We're just going to mention the general principle of it. Right. So just now, if you remember what I said about time of supply, normally we only look at 2 events, right? We only look at payment received or invoice issued, whichever earlier. All right, and then we use that to determine, whether did the time of supply, did the supply happen already? What's the GST rate to apply? All right, but for the GST rate change, we need to look at one more element, which is when the goods are delivered or when the services are performed. Right, so we look at all 3 elements together. Right, if any of these events straddle the GST rate change, then that's when the transition, that's when we need to look at the transitional GST rules to see what's the correct rate to apply. Is it 7% or is it 8%? All right. In Gs I'm not going to cover in detail, right? But in Gs, we normally disregard the invoice date for the GST during the GST rate change, right? So regardless of when you really issue the invoice, right, the invoice itself, the invoice date does not determine the GST rate applicable. All right. The easiest would be to look at payment. All right. So for example, if payment is received in full, okay, before 1st Jan, right? So before 1st Jan, right, that means last year, the GST rate is 7%, right? If payment was received in full last year, the GST rate is 7%, right? If payment would be received in full only this year, all right, and then all the goods will be delivered, or all the services will only be performed this year. So everything this year, only invoice last year, but everything else this year, right? Everything else is after 1st Jan. Then the GST rate is 8%. All right, so it's quite straightforward. Usually we look at payment. If let's say it straddles, or part, partial. All right, so for example, part payment received last year, part payment received this year. That's when we have some apportionment to be done. All right, this flowchart is from the e-tax guide GST rate change 2023 GST rate change. If you want to find out more about the rules, please go to the guide. I'm not going to cover this in detail because there are many transitional rules. But by and large, that's the general principle. It's the same thing also for, let's say, what happens if the invoice is issued only this year. Okay, let's say the invoice is issued in mid-Jan 2023. All right, it's the same thing. Actually, the rules are quite similar. There's some small differences. It's really about what are the options available to the supplier. All right, but the rules are quite similar. Even if the invoice is issued this year, okay, or let's say the invoice is issued on the 10th of Jan, but the payment was completed, payment was received in full last year, all right, GST is still chargeable at 7%. All right, again, you only apportion when, let's say, the payment straddles. All right, so basically in Gs, right, we disregard invoice. We don't really look at invoice date. I mean, you still must issue the invoice. It's not as if no need to issue the invoice. You still must issue the invoice, right? But we don't use the invoice date to determine the GST rate applicable, right? The first and easiest would be to look at payment, right? When is the payment received? In full. Okay, received last year, 7%. Received fully this year can be 8%, but the supplier depending lah. For example, if payment received this year only, but actually, right, the goods were delivered last year. That means goods delivered before 2023, but payment received this year. The supplier has the choice to say that even though I receive payment this year, right, I can still go and charge GST at 7% because my goods were delivered last year. Right, so all these different permutations are they are summarized in this flowchart lah. So you guys can go through later. Right? Can All right. And next up, okay, before we talk about the standard rated, zero rated, exempt supplies and all that, okay, let's touch a bit on deemed supply, right? At the earlier part of the class, I mentioned just now that deemed supply actually by right is not a supply, okay, because there's no consideration. But under the Act, we deem it to be a supply, all right? And typically, because there's no consideration, the businesses have to account based on the open market value, right? So some common categories, there's quite a few, right? All the deemed supplies are in the second schedule to the GST Act, right? So GST Act, you go in online, you just scroll down to the second schedule, right? As you can see all these provisions, right? These three are the most common ones, right? The most common would be gifts, right? So for example, you give goods free to your customer, to your employees, to your associates, right? So for example, let's say you buy the gifts, right? And when you buy, right, let's say you buy from a GST registered supplier, you would have incurred GST, right? And sometimes when you buy, maybe you don't know that it's for gifts, you see. So you may have claimed the GST, or it could be easier that everything you buy, you just claim also, which is fine, as long as you satisfy the input tax condition, all right? But when you give it for free, so what we are saying is, as long as you have claimed the input tax, when you give it for free, and the gift, right, per gift is more than $200, right? In that case, it's a deemed supply. You need to account for GST on the gifts given free, right? Based on the open market value of the gift, all right? If it's above $200, if let's say per gift let's say it's a very small gift or it's a sample only, you're giving some samples to your customers, those kind you don't need to account. All right, there's an exception to the rule. You don't need to account because we also don't want to make it so onerous, such that every small gift also the supplier must account, right? But if it's above 200, it's sizable enough, right? Then and you had claimed input tax, you need to account for it, right? Right. Then the question is, can I don't claim then? Because I know I'm going to buy this, right? I'm going to give it for free, right? Say I buy hamper, and then you want to give to your customer during festive occasion, right? Since you already know it's a gift, you do not want to do this in and out thing, this book entry, can you choose not to claim? The answer is yes. All right. The business can choose not to claim. If you don't claim, you don't need to account. All right. Sometimes, so it's really a choice for the business, but sometimes, for example, it could be goods that you manufacture. For example, you're a manufacturer and you manufacture the goods. So you would have claimed input tax on the raw materials. It's not like you never claim anything. You did, but it's on the raw materials. Then those kind you won't be able to differentiate, right? Like, which raw materials are to make gifts. So if in those kind, then we take it as you have already claimed. When you give the goods for free above $200, then you just account for it. Okay, so the $200 is per gift, not per customer. So let's say, right, you send 10 hampers to one customer because maybe you say 10 hamper for the 10 different employee of that customer. Then one is considered 10 gifts. If each hamper is more than $200, yeah, then you need to account for GST. Okay, the next common scenario is for your business goods that you put to private use or non-business use for free, right? So for example, say you are, say, a car washing company. Yeah, I randomly pick example, right? You are, let's say, a car washing company, all right? And then you provide car washing services to your employees for free, all right? So you're actually putting, all the equipment and all that, right? You are putting it for free, for non-business use, for private use of your employee, right? In those cases, you still need to account for GST. It's considered a supply of service. Paragraph 5.3 is considered a supply of service. Right? You still need to account for it. Okay, then you may ask me, then how to account this kind? How I know how much equipment I use for this kind of purpose. So in this kind, usually we use a proxy. Right? So for example, right, your car washing company, right? Normally you wash one car, say $10 lah. Okay, example, yeah, $10. And then you allow your company, you give them vouchers so that they can, use this for free. They can get this kind of services for free. What you do is for every single employee that you provide this service, you just account based on $10. All right, so we use a proxy lah. For the second one, it's a bit harder. It really depends on the business scenario. It's a bit harder to identify the market value, right? But basically what we're saying is, you claim all this. The reason why we allow you to claim all the input tax, right, is because the input tax is for you to make supplies in the course of furtherance of your business. Remember, going back to the basic principle, we allow you to, we say that as a GST registered business, you must account and you can claim input tax for whatever in the course of furtherance of your business. But even though you claim input tax, in the end, you put it to a non-business use, right? Therefore, as a tax avoidance or clawback mechanism, you need to account for the GST. All right, and last but not least, the next common scenario is for goods that you held at deregistration. So again, while you are GST registered, right, maybe you buy a lot of goods is meant for your business, you already claim all the input tax. All right, and then halfway through, you decided to say cancel your GST registration. Deregistration means cancel GST registration. All right, could be because maybe your business turnover dropped, below 1 million, and you don't want to be GST registered anymore. All right, so in those cases, you can apply to cancel your registration. Right, but when you cancel your registration, on the last day of your registration, let's say you have all this business asset and they exceed $10,000 and you claim before, we need you to account one lump sum back. Okay, account deemed output tax. Okay, the reason being, had you not cancelled your registration, had you continued to be registered, subsequently, all these goods that you have, and you subsequently, when you sell them, you would charge GST, correct? Yeah, so you would have, because GST is always an input and output thing, right? We allow you to claim input, because there will be an output, right? So had you remain registered, there will be an output GST because you will sell the goods later. But because now you cancel your registration, if you sell the goods only after that, you don't charge GST. You are not supposed to charge GST. Right? So in that case, there is a so-called tax loss in that sense. Right? We don't get back the output GST. Right? That's why at the point before you deregister, as on the last date, we ask you to deem it back. Okay, just total up all your assets. If they exceed more than 10,000, right? Just use the open market value and just account GST. Okay, if you have claimed input tax lah. Of course, if the assets you have are those that you never claim input tax, right? In the past, it could be those things that you purchased before 1994, right? But I think now not really lah, quite rare already. So example could be you buy from non-GST registered supplier. Okay, back then when you buy, if the supplier was not registered, then you would not have claimed any input tax. So those kind you don't need to deem. Okay, so this is what I mentioned, right? You do not need to deem, right, if there was no input tax. Okay, whether is it a case where you were not entitled to claim the input tax in the first place, right, or you choose not to claim. Right, there are certain exceptions also in the law, in the second schedule. If you provide, say, free accommodation in a hotel for your employee, or you provide free F&B for your employee, you also don't need to deem. Right, but otherwise, you need to deem if you give it for free. Okay, the reporting in the GST return for deemed supply is similar to standard rated supply. Okay, you just report in the value of supply is really based on OMV lah, based on a purchase price of any identical goods at that point in time, right? That will go into your box 1, right? And your output tax will go into the box 6 based on 8%. Okay. Okay, let's move on. Okay, now we'll talk about exempt supplies, right? Do let me know too if you guys think it's a bit like overwhelming and you need a break also, right? Yeah, those who have questions, I'm trying to answer your questions later, maybe after the break. Yeah, just continue typing in the chat. Okay, just now I talked about exempt supply already. Okay, these are supplies that's totally exempted. Okay, no GST at all. But remember, you cannot claim input tax for the making of exempt supplies. There are only 4 categories of exempt supplies. These are exempted more for policy reasons. Okay, I will touch on each of them briefly. Right, the first, I think the one that we all know most is really about sale and lease of residential properties. Okay, so exempt supplies are all in the 4th schedule. Okay, go to the act, you see that at the bottom, 4th schedule, you will see all the list of exempt supplies. All right, so first category is the sale and lease of resi property. All right, and the rationale why we exempt is to really ensure that housing remains affordable for most homeowners in Landscar Singapore. All right, so for example, our HDB flats, right? We want to make sure it remains affordable, even though the price is not very high. All right. But I think the policy, the GST policy is to not add on GST to the already high prices. All right. So exemption will apply for vacant properties, vacant residential property. If it's a land we're talking about, we look at vacant land zoned residential. So for land, we look at zoning. If it's just a land, right, we look at the zoning. If it's zoned residential, all right, then it's considered to be a residential property. Okay, that will be exempted. If let's say it's a building, right, you got land and then you got building on top. Okay, so if there's a land and there's a building, we will look at the building instead of the land. All right, so as long as the building is approved for residential use by URA, right, then if that's the case, we will consider it to be a residential property. When you sell or lease that residential property, bare property, the bare property will be exempted. No GST needs to be charged. All right. But sometimes, so most of the time it's quite obvious. We look at the approved use. All right. Okay, so for example, we do have certain kind of properties, for example, say dormitories, workers' dorm for the foreign workers, right? So workers' dorm, we don't really look at the approved use in from URA. What we look back, we really look at what's the main purpose. Okay, the main purpose of workers' dorm is for accommodation of the foreign workers, all right? And if there's a permanency to it, all right, it's meant to be used at least 6 months or more. It's meant to be used as accommodation, all right? Then in that case, we consider it to be a residential property, right? The same can apply to service apartments as well, right? So service apartment is mainly for accommodation as well, right? Okay, so that's about it for residential property. You can read through. There's a lot of definition in the 4th schedule, right? But in gist, that's what we mean. Okay, so I need to emphasize on this word. It must be the bare of vacant property. All right. So for example, say if you lease out a condominium, right? You lease an apartment to a customer. Then the apartment is fully furnished. What is exempt is only the bare property. All right. Later I'll show you a bit roughly how we compute. Basically, we use the annual value as a proxy of the bare rent. All right. What is exempted is only the bare or the vacant rent. Right. The furniture and fittings, there's a need to apportion. Okay, if it's come fully furnished, the furniture and fittings will still be subject to GST. The exemption does not apply to furniture and fittings. Okay, so that's residential property. The next category of exempt supply is financial services. The 4th schedule has a very long list of financial services that are exempt from GST. And the reason for exempting it is really more because it's very difficult to determine the GST, to determine what's the value of supply. Remember just now we say GST, output GST always come hand in hand with value of supply. You need to know what's your value of supply first. Then you charge GST on top. But for financial services, it can be very hard to know what is the value of supply, right? So for example, say you do currency exchange, I buy, you sell that kind. Then how do we determine what is the value of supply? Do we use the entire sum of money being exchanged? Then that will be inflation, right? Because actually at the end of the day, from a financial transaction like that, what you get is only the gain or loss. Yeah, so because of all these kind of difficulties, right, most countries, Australia, UK, and all that, EU, all the countries, they exempt financial services from GST. Of course, the definition of exempt financial services could differ from one country to another, but by and large, they're all exempted. Right? Our list of financial services are closer, I think, to Australia's, right? So it's quite similar. So for financial services, these are some examples. Not exhaustive. I think these are most of the financial services that we exempt under the fourth schedule. All right. So common ones would be, let's say, you open you operate a current deposit or savings account, interest on bank account. Those are common. Currency exchange, right? Credit card operations, and then shares and bonds and so on. All right. Point to note is, how about dividend income? All right. So I think it's also very common to confuse dividend income with a financial service. Right. So a lot of people think that, oh, financial service exempt, so dividend income must also be exempt. That's not true. Okay. Technically, dividend income is not a financial service. Right? Dividend income is like a passive income you receive from your investments, or from your the shares that you hold in a certain company, right? You don't do anything for it. There's no supply. Remember just now, for first principle, for it to be within the scope of GST, there must be a supply of goods or services. All right. But in the case of dividend income, it's passive income. You didn't receive it for any goods or service. Therefore, dividend income is outside the scope of GST. Right, so this is important, okay? Dividend income outside the scope of GST, not exempt. It's out of scope. Okay. Then third category of exempt supply. This one is quite new, a couple of years old. So when we first started the GST Act, we only had the first two category, residential property as well as financial services, right? Investment precious metals were added later, right? Because I think investment precious metals we recognize that essentially it's like financial assets. Traditionally, people trade in stocks and bonds, but increasingly people also trade in IPM, investment precious metals. It's not about the metal per se, but it's really about the trading value. All right. So investment precious metal has since been exempted as well under the fourth schedule. There are certain definitions. Not every gold bar, is considered investment precious metal. You need to meet certain criteria. All right. Basically, we're looking at the investment grade lah, the 995 at least. And it's those that you can actually trade it on the bullion market. All right. Jewelry is not IPM. Okay, gold jewelry is not IPM, right? Gold jewelry would be just like any other goods, right? It will be subject to GST, right? We exempt only IPM. We exempt both the supply leg and then the import leg as well. Right, and then last but not least, in 2020, we also added, basically this is the cryptocurrency into the list of exempt supply. All right, so in the past, way before, because I think cryptocurrency only cropped up, increasingly popular only in the last couple of years, right? So in the past, we didn't really have a specific rule for cryptocurrency. I mean, the correct term in the law is digital payment token lah, but I think commonly we call it cryptocurrency. So in the past, we don't have any specific GST rules. So once you don't have any specific GST rule for that kind of category of goods or service, the normal rules will apply. So in the past, all the supply of cryptocurrency, supply, lease, and all that, import also, everything would be considered to be a taxable supply because you fall back to the normal rules. All right. But after Jan 2020, we put cryptocurrency was added into the list of the fourth schedule exempt supply, right? So everything's exempt, right? You supply the cryptocurrency is exempt. You provide it as a loan, it's also exempt. You use it for any other purpose, also it's disregarded and so on, right? All right, so just to note that while we have those four categories of exempt supply, we do have caveat, okay, in the fourth schedule itself, which says that, while all those services are exempt, right? But then if you actually provide a service, consisting of arranging any arrangement services, any broking, stockbroker, is you earn commission for it, or you earn brokerage fee, right? This, while the underlying equity, underlying services are exempt, the arrangement or the brokerage services are not exempt. All right. The services are still subject to the normal GST rule. They'll be taxable. All right. So again, sale of shares, the sale of shares itself, the sales proceeds will be exempt, but the stockbroker who provide the services, his brokerage fee will be taxable, right? Same thing, like say a real estate agent. So real estate agent, right, sell your house, right? The sale of the residential property is exempt. The commission that the real estate agent receive is still taxable. All right. Second point, I already mentioned just now. Okay, exemption only apply to the bare property, right? So any sale and lease of movable F&F, furniture and fittings, will be considered to be taxable. All right. Third point is for example, say condo. You have the MCST. You pay the maintenance fee to the MCST, right? The maintenance fee will be taxable as per usual. All right, this will just highlight some of the common exempt transactions, the more common ones lah. IPM and cryptocurrency, they are quite niche. They are not so common, right? But what is more common, even for taxable business, right? So you can have a business, right? A normal taxable business, you buy and sell goods, right? But at the same time, right? Because at the end of the day, you need to finance your business, right? Or you buy and sell goods, you still deposit money, in the bank. Right? So a taxable business can also have some exempt supplies, and they must still report, okay, in box 3 on the GST return. So for example, say a taxable business, they earn interest income from bank deposit, right? If the interest income is from local banks, it's exempt supply. If it's from overseas bank, it's a exempt supply, but they can qualify for zero rating, right? In short, it's still exempt supply lah, right? Or for example, say you provide loan, right? You provide a loan, in return, you receive interest. So if you provide a loan to a local customer, right, you receive interest, the interest is exempt, right? Provide loan to overseas customer, right? The interest is an exempt supply that qualify for zero rating, right? So they may wonder, what is this lah? What is this exempt supply that qualify for zero rating? Okay, this one affects the reporting. So for exempt supply that qualify for zero rating, you report it as in box 2, zero rated supply. You don't report it in box 3. Box 2 is zero rated. Box 3 is exempt. Okay, if it's local, it's exempt. If it's from overseas, it's under box 2, zero rated. Right? Then the question is what value to report, right? So for interest income, the value is the gross interest income. All right? It's not the deposit amount or not the loan amount. All right? The consideration, so to speak, right, is actually the interest income. All right. Then next one, if you talk about no foreign exchange gain or loss, this is the exempt supply. All right. This only occurs when you change you exchange money in foreign currency. Okay. So this one, for the value of the exempt supply, we will ask you to take the net gain or loss. Right. So for example, in transaction 1, you have a gain of 500. Transaction 2, you have a loss of 200. All right. So you net it together. It's a gain, right? Okay, it's a gain of 500, a gain of 300. Yeah, so what you will do is you report 300 in box 3. Okay, but let's say if you net it, it's still a loss. Let's say, just now my example was, I net it is still a plus 300, right? I just put 300 lah in box 3. But let's say it's a loss. In the end, the net is a minus 300. In box 3, you will still report 300 only. Just ignore because at the end of the day, we don't care whether is it a plus or minus, you see. We just want to know the quantum. So whatever is, just get the net and then just drop the plus or minus sign. Okay, so if it's a net loss, just report as absolute amount. All right. For next one will be for, let's say you sell or issue share or bond. All right. Sale and issuance of share and bonds, they are exempt supply. To local buyers, exempt. On local exchange is also exempt. To overseas buyers, that it will be an exempt supply that qualify for zero rating. Okay. And then the value will be your gross sale proceeds. Okay, lastly is the resi property that we spoke of, right? So we already spoke about this just now. So basically, when you are selling the property, you just take the selling price. Remember, okay, the exemption only apply to the bare property, not the furniture fittings or any commission involved in the sale, right? The value of exempt supply in box 3, for sale, you take the selling price. So sale is straightforward, take selling price. For rental, it's a bit more complicated, right? So because for rental, right, we don't take the entire rental amount, right? The bare rent of the rental, what we do is we take the annual value of the property, right? And then we take 1 out of 12. 1 out of 12 is to represent the monthly bare rent. All right, so the computation for exempt supply for lease of resi property is a bit different. We take 1 over 12 of AV. Okay, just to wrap up the exempt supply bit, okay, I think I mentioned it just now. Okay, what are some of the implications? Why do you need to be very precise in knowing what's exempt supply and what's not? Because one, exempt supply, remember exempt supply is not considered to be taxable supply, right? Exempt supply, you don't include it in determining that 1 million GST registration threshold. Okay, so the implication is if the business only have exempt supply, it cannot be GST registered, right? Because remember, you only can be GST registered if you make taxable supply. Exempt supplies are not taxable supply, right? So only the exempt supply cannot be registered. Okay. Then we also mentioned, right, exempt supply means no GST, but at the same time, you cannot claim, right? Input tax that is directly attributable to the making of exempt supplies is not claimable, right? So you incur input tax, say to, just now I mentioned, right, you incur input tax, say to sell your shares, right? That is an example of input tax that's directly attributable to your exempt supply. You cannot claim. All right. Of course, the more common scenario is usually you make both lah. You incur, let's say, overheads, right? And then your company say make both taxable and exempt supply. Okay, this will make you a partially exempt person. All right. Then in that case, we allow you to apportion. Basically, you only can claim a small amount of input tax, right? For your taxable supplies. Okay, there's some apportionment method. We'll touch a bit on this later or on the input tax section, but not in depth. Okay, the partial exemption rules, again, is another complex module, which you can refer to the e-tax guide. All right, then just now we mentioned this, right, about exempt supply. Sometimes when it's an exempt supply, if it's local, it's exempt. When you go and say you provide a loan to an overseas customer, all right, then it becomes a zero-rated supply. So for GST purpose, you report as zero-rated supply. Correct? You report in box 2, not box 3, because zero rating override exemption. Right? The on the flip side, the good thing is because now it becomes a zero-rated supply, okay, you can claim the input tax, right? Because the basic input tax rules is input tax for making of zero-rated supply can be claimed. Okay, so if it's local, it's exempt supply, you cannot claim. Once it qualifies for zero rating, right, you can claim the input tax. Let's see. All right, it's 10:30. We already done, I think already 1.5 hours. So maybe I think we can take a break while I also run through your questions. And then after the break, I will address your questions. Right? Yeah. Would that be okay? Wait. Right. So shall we take a break? Maybe we'll take 15 minutes bio break. Everybody come back at 10:45. Would that be fine? All right, Ken. I'll see you guys in 10:45 then. Thank you. All right, let's get started. I saw a couple of questions in the chat, so I thought I'll take them first before we move on. I think there's quite a couple of questions on the GST rate change. So I'll think we'll take that together, right? But maybe I address Giglen's question first. Giglen, I hope you're here, right? So her question is, if let's say we have a local GST registered company, they rent a machine to company B, another local company, and really charge output tax. right? But then the machine is subsequently moved to Thailand for the customers overseas permanent establishments use. Okay, your question is whether the whether the income is subject to withholding tax by Thailand. Okay, this one I cannot answer, right? This is on withholding tax. Okay, right? I can't comment on this. I'm not the best person to comment on this lah, because I only can address the GST question. All right. So the withholding tax, if if this is a valid scenario, I suggest you call or write to us lah, to IRAS, right? The withholding tax department, right? But the question is about the output tax, the output GST. So it depends. If let's say the supplier had charged full GST for the full rental period, okay, because the supplier had charged GST on the full rental period, assuming that the machine will be used in Singapore, but right halfway through the machine is now used overseas, right? The correct way is for customer B to go back to the supplier and say, from this period onwards, the machine is used overseas, right? So if the machine is used overseas, by right the rental can be zero rated, right? So you actually can tell the supplier, okay, if the supplier hasn't charged the rental for those months that the machine is used overseas, those months later on when the supplier invoice, they can just invoice at 0% GST. If the supplier already charged the full rental at 8% GST, B can ask the supplier to say, can you reverse out? So for the period that the machine is used overseas, the supplier can issue a credit note to reverse out everything that was charged already, all right, and then subsequently issue another invoice for 0 rated, okay, for the portion or the rental for that the machine is used overseas. All right, so that's what the supplier can do. So I hope that addressed your question. All right, then there's a couple of questions on GST rate change. Okay, so for the first question is whether the GST transitional rules will apply for the exam. There will be a simple question on it. All right, nothing very, very complicated. Basically, you just have to know, I think what I mentioned in the slide earlier. All right, we don't really look at invoice date. What we look at is payment date, okay, when full payment we receive, and then as well as when the goods or services will be fully delivered or fully performed. That's all you need to know. Right, there'll be a simple question. I cannot tell you more than that, right? But yeah, so basically that's it. You don't need to read the entire rate change guide for the exam purpose. All right. The next question is from Tan Shu Tong. What if the invoice had been issued last year and submitted GST last year? Okay, so I assume what you're asking, okay, correct me if I'm wrong, yeah? I assume what you're asking is, last year, the supplier already issued the invoice with a 7% GST and already submitted the GST return, but the payment or the goods or services will only happen this year. If that's what I assume you're asking, the point is, again, remember just now we said we don't use the invoice date as the sole indicator to determine the GST rate. It doesn't matter if the invoice was already issued last year or its GST was already submitted last year. If it was already done with a 7% GST, but for the supply, payment will only be received this year, or the goods will only be delivered this year, all right? What the supplier need to do is credit note out the entire invoice from last year, credit note out everything, issue a new tax invoice with an 8% GST. All right. So whatever do in the last year, we don't count. It doesn't matter, 7%. But what you need to do is reverse out. All right. Okay. Then Claire's question is for IT company billing for subscription of software from December 22 to December 24. But the license keys were all given on December 22. Okay, but payment is only in this year, right? Payment is only made this year. All right, this is what we call a continuous supply of service, right? So for Claire, right, if this is a valid scenario, I suggest you go to the rate change e-tax guide. This is under the continuous supply of service. All right. Basically, right, the answer to your question is because payment is only this year. All right. If I assume the invoice is only this year in Jan 23 as well, by right, the supplier can charge 8% GST, right? Because payment is received this year, invoice also this year. But there is a portion of this service that was performed last year, the December 22. Right? I assume this is monthly subscription, yeah. So technically, the supplier, he can choose to charge 7% GST only for the subscription for the month of December 22. Everything else is 8%. Right? But if let's say the supplier choose not to charge 7% for that month only, he want to charge 8% for everything, it's also fine if invoice and payment is in this year. Right? We don't look at the license keys. Okay, this is continuous supply of service. We don't consider the supply as being completed. Okay, the supply is ongoing. So we look, this is assuming it's monthly subscription lah. So basically we're saying that the supply is a continuous supply that will keep happening from month to month. Right? Right. I think Claire had a similar question also about how just now because I mentioned, right, we don't look at the invoice. Is it because the payment of the invoice will override the date of the invoice? Yes, it does. Right. And is it because the invoice can be amended by the supplier, and whether the supplier decide which rate to impose? Okay. I'm going to share the rate change e-tax guide with you all, since you all have quite a couple of questions indeed. Maybe I just share, wait, let me see if I can share screen. Okay, I don't want to spend too much time on this because we do have quite a lot to cover, and like I said, there will be a very simple question only on the rate change e-tax guide. All right. Later on, you all can go lah. It's on the IRAS website. You just just Google or go to the IRAS website and search for rate change e-tax guide. Okay, so I think, right, what will also be useful for you guys besides the flowchart in my slides, okay, I hope you all can see lah, right, is for you to go to Annex A, okay, of the rate change e-tax guide, right? Then you see maybe this way of presentation could be easier also for you, right? So basically, right, for example, first thing you look is the invoice issued before or after 1st Jan, right? But like I say, later you see the GST treatment don't make a lot of difference. So we don't use the invoice to determine the GST rate. Okay, there are only slight differences, right? So if let's say the invoice is issued before 1st Jan, right? But payment, let's say you see the second one, second column, second row. Payment is received after 1st Jan. All right. So by right, if payment is received in full after 1st Jan, you must apply 8%. All right. But if payment is part, okay, part of it before, part of it after, then you can do a apportionment and then apply 7 and 8% respectively. All right. Then just now, right, there was another question, Claire's question, right? Can the supplier choose? So if the invoice is issued before 1st Jan, the supplier cannot choose. All right. The rules are fixed. All right. Either you look at payment, or let's say part of the services or goods are straddling, right? They must apply the rules accordingly. Okay, but let's say the invoice is issued after 1st Jan, right? So if invoice issued after 1st Jan, but payment received before 1st Jan, GST is 7% fixed. Okay, payment received in full before 1st Jan, right? Fixed. Payment override. Don't care about the invoice date ready. Okay, payment will override. Right? But let's say the payment also straddle, right? So invoice after 1st Jan, but payment straddling, goods delivered or services performed also straddling, right? In this case, there is some election, right? You see the words here under remarks, okay? Under the remarks column, it will say you can elect to apply blah, 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 right? So there is some discretion given to the supplier. Basically, what we're saying is if the invoice is after 1st Jan and payment is also after 1st Jan, the supplier is okay, it's acceptable for the supplier to charge 8%. All right. But let's say right, this is, I think, the software question, right? But let's say there was a portion, that was done, a portion of the goods or services that was delivered before 1st Jan. We allow the supplier to choose. Does he want to, for that little portion, does he want to charge 7% GST? This is something that has to be mutual. I mean, we say supplier can elect because for GST, the onus is always on the supplier. But of course, as a customer, you can go to the supplier and say, hey, actually this one, right, you deliver to me already before 1st Jan. Can you just charge me 7%? It's a mutual discussion. All right. This is the only part where the supplier have a choice. All right. I don't want to go through in detail, but you all can go through after this class live. You have this kind of, I think this period you may have quite a lot of such questions, with it's straddling over, and this period you should be doing the GST submission. I think by end March, right? In April, you'll be doing the submission for the Jan to March quarter, and you may have a lot of such supplies. All right, so do take a look. It's either you use a flowchart or you use this table. I think either way will be quite useful because the guide is quite long. Right? Okay, I'm going to stop sharing this, yeah? Okay, have I addressed all the question? Paul's question, exam is based on YA 22. Then, okay, so your question is what GST rate to use. All right. Okay, for GST, right, we don't look at YA. I know the instruction given to you guys for CPA is by YA lah. But for GST, we don't look at YA. We always look at calendar year, right? But in a way, you are correct. All right. So for the GST exam question, all the question will be based on transactions happening in year 2022, right? It's not year 2021, right? For GST, it's a current year basis. All right, so it's 2022, correct. So by and large, the GST rate is at 7%. Just have to take care about the rate change question. I already give you all a hint, right? There will be a simple rate change question. All right, just be careful. Just when you get the exam paper, please read carefully the year. All right, so don't make this assumption because GST does not go by YA. Right. Last question now on the rate change before I move on. JC's question, you receive full payment on 20th December, but goods delivered in Jan 23. By when you need to issue the invoice? Invoice always need to be issued within 30 days of payment received or goods delivered. All right, so you need to issue, you are correct, because full payment was already received last year. You are right, it's 7%. All right, but you need to issue the invoice within 30 days. That one is standard invoicing rules, has nothing to do with rate change. Right? Right, but I just want to highlight, right, JC, right, this supply must be accounted for in October to December's return, yeah, October to December 22, because you already receive full payment. Remember, this is original time of supply, right? Payment received or earlier of payment received for invoice issue. All right, so since you receive payment in December, you must account it in the October to December return. If it wasn't accounted for already, you need to go and you need to do adjustment F7. Right? The normal GST return is called F5. The adjustment form is called F7. You need to do a F7 for the October to December period, which you should have filed already by Jan. Right? Okay. Hannah, let me move on. Let me go back to sharing the screen. If you guys have any question, just continue typing it in. If we have time, I think we'll run through later. Sorry. Okay, let me see. Okay, everyone can see the slides. We should be at the zero rated supply section. Right. So just now we've already talked about exam supply. Standard rated, I mentioned nothing much to talk about. All right. So we are now talking the last one, zero rated supply, before we will move on to the input tax section. All right. Zero rated supply, I think like I mentioned earlier, there are only two broad categories, not complicated. Okay. For goods, we're only looking at exported goods. Right. For services, we look at what we call international services. Okay, so international services, again, is quite complex. It's a list of services that can qualify, right? It's not really a list, it's not a specific nature, but the list here, section 21.3, refer to the different nature of services that can qualify as international services, right? So basically, right, any service that fall in that list, section 21.3, it's quite a long list. I think it's A to Y, right? Can qualify for zero rating. Okay, generally the similarity is all these services, they have their international, they have international character by default, right? So things like international transport, you have your air freight, right? Those international, right, will be zero rated. All right, IDD calls, That's international again, that will be zero rated. Services that you perform on goods or land overseas also can be zero rated. All right. I think I've said this a couple of times already. Zero rated supply is more favorable because you can claim input tax, even though the output tax is zero. All right. So just to touch a bit, for exports of goods, all right, export of goods is very straightforward. The goods leave Singapore. All right. So the complexity, or I think what we need to be very careful of, is the documentation and the certainty, whether the supplier has certainty that the goods will be exported. All right. At the end of the day, we need to be absolutely sure that the goods will leave Singapore. All right, in order for the supplier to zero rate. All right. Why the supplier needs to be very sure? Just now I said earlier, the onus to account GST is always on the supplier. All right. So if the GST is self-assessment, if the supplier thinks he has certainty and he will get the documents, we have 60 days, right? The supplier must have documentary proof of the export within 60 days. So if the supplier is very certain, very sure, then the supplier can charge 0% GST. If subsequently the goods are found to not be exported, all right, then the supplier will have to reaccount the 7% GST. All right, so this is the where, before the supplier apply the zero rating relief, please be very sure first, right? Because if not, right, and he cannot recover the GST from the customer, okay, because a lot of time exports of goods, the customer could be overseas as well, right? If the supplier cannot recover the GST, he have to fork it out of pocket. All right, so like I said, okay, how does the supplier have certainty, right? The most certain way is if the supplier arrange to export himself. All right, so supplier either export out himself, get his own freight forwarder to export out the goods, and then he will have all the documents. That's when we say supplier can have certainty, right? But still must get the documents within 60 days. All right. I think one common scenario is, what if, let's say, because sometimes customers can give certain instruction. Again, customer can tell the supplier, oh, can you deliver to my related company here? No, I have a related company here. Can you deliver to them? Later, they will export out the goods. And then they will give you the documents. In that case, right, we will say the supplier does not have certainty. Okay, the supplier cannot zero rate. Basically, the supplier zero rate. Okay, so the strict GST rules is cannot zero rate. If the supplier really went on to zero rate and we find out, right, we will say you must adjust it back to 7%, 8%, sorry, 8% now. All right. Sometimes what we do allow is what we call indirect export. Indirect export. So for example, so if the supplier export himself or the supplier get his own forwarder to export, that's what we call direct export. That one most certain. Right. Sometimes the customer may say, I have my own freight forwarder. I ask my freight forwarder to collect from you, the supplier. That one is indirect export. We also allow. Okay, only if it's a freight forwarder who will come and collect and export out the goods. All right. If the customer asks supplier to deliver elsewhere in Singapore, or customer himself go and take the goods in Singapore, right? All those cannot qualify for zero rating. All right. There is a GST guide on exports. You all can take a look. There are different scenarios inside the guide with the correct documents to maintain. So we are very strict on the documentation for export. All right. So besides the typical transport documents, like by ship you need bill of lading, by air you need airway bill. There's a lot more other documents we need. All right. So businesses do not need to submit to us when they file, right? But as and when we audit, we may call for it and they need to be able to furnish us the documents. All right. International services, I think just now I mentioned, right? We look at the list in section 21.3. It's a long list, okay? So we use certain proxies to determine whether is the services international in nature. The general principle, if the services is international in nature, then we allow zero rating, right? So for example, just now, right, we had that scenario, that question that was asked about rental. If you rent goods and the goods, you rent out goods and the goods are located outside Singapore, all right, that would be an example of what we call services supplied directly in connection with goods outside Singapore. All right, and that can qualify for zero rating. That's under section 21.3F for your info. All right. So, but then let's say you supply services. Okay, so services, even though you supply the service to an overseas customer, it does not automatically make it a zero rated supply. All right. So for example, you supply service to overseas customer, but let's say it's to repair the goods in Singapore. Physical repair services, repair the goods in Singapore. That services will still be standard rated because it's services supplied directly in connection with goods in Singapore. Okay, that one cannot qualify for zero rating. All right. So how it works is typically if you have such a service and you think it maybe can qualify for zero rating, go through the list. Roughly, this is how the different provisions the by industry, roughly which provision is more likely to apply. You can zoom into those, and then you need to read through that provision to see whether does it really apply or not. Okay, if can apply, then can zero rate. If cannot, then it is a standard rated supply by default. Okay, that's how it works for international service. Okay, so that's all for the supplies leg. All right. I think I've covered quite a few bit. Okay, before we move on to the input tax claim, okay, I think why don't we have a quick poll, just to test your understanding on the different supplies, and then we wrap up, and then we'll move on to the input tax, the claiming bit. All right. Hang on, yeah. Okay, are you guys able to see a poll? Okay, it's a GST poll on supplies. Anybody can see? Yes, can see. Okay. Are you able to click on the poll? Somehow I can't see whether you're clicking or not. Can click, yeah? Okay, can. Okay, I'm gonna end the poll now. I think most of you guys have already answered. Yeah, so I'm gonna end it now, yeah. Okay, right. So if you can see the results, right? The first question, okay, we have supplier A who sell goods to customer B, and the goods were shipped from China to Korea. So what type of supply is this? So most of you got it right. Well done. Right. So the answer is out of scope supply, the last one, right? Right. Because this is what we call third country sales, right? The goods never enter Singapore, right? It doesn't matter whether the customer is local or not, all right? So for goods, we only look at physical movement of the goods. In this case, since the goods is from China to Korea, it's out of scope supply. All right. I know some of you chose standard rated or zero rated. Okay, but I hope this addressed the confusion. Remember, this is important, right? For you to know, it's very common for people to be mistaken out of scope and zero rated supply, right? And we don't look at where the customer or who's the customer for goods. All right. Question 2. Supplier A sell goods to overseas customer C who requested the goods to be delivered to its warehouse in Singapore, right? Then customer C will export the goods and provide the documents within 60 days, right? So how should A treat this transaction, right? So can see the response is about half, right? The correct answer is zero rated supply. Okay, the second one, right? This is the scenario that I was emphasizing just now. All right. At the end of the day, for a supplier to zero rate export, there are two things he needs to be sure of. One, he must have certainty of the export. Right. And two, he must have the export documents within 60 days. So in this case, the second condition is met, got 60 days, right? But the first one, right, in this case, the supplier does not have certainty. Like I said just now, certainty can only be supplier export the goods himself or get his own forwarder to export. Or else the customer get the customer's forwarder to come and collect the goods. These are the only scenarios that we allow, right? So in this question, right, the customer asked the goods to deliver to a local warehouse, right? I'm not sure if the question is a bit unclear, but okay, in short, right, so if the customer, if the goods are delivered to the customer's warehouse in Singapore, right, this is local delivery. The supplier must charge standard rated supply. Sorry, I think I said wrongly just now. The answer should be standard rated supply, not zero rated. Yep. Right, it should be standard rated supply, not zero rated. Yeah, see more of you choose zero rated. All right, so the correct answer is standard rated. Okay, so this question is very important. Yeah, all right, this is very common confusion. All right, then question 3. Okay, there are four types of services here. Which of these are not exempt supplies? Okay, most of you got it right. Credit card annual subscription fee. Okay, the first, second, and the fourth, they are all exempt supplies. They are all financial services within the fourth schedule. All right. For credit card annual subscription fee, right? This is specifically excluded. All right. This is not one of the exempt supplies. Okay. This is the normal subscription fee you pay. This is taxable supply. Right. And then the fourth question. All right. The fourth question. If the company A purchase some gift worth 300 and give away to the customer, right? Which is true. Right. So the correct answer should be the second option. All right. Remember, right, we only asked the supplier, the business to deem, okay, account for deemed output tax only when input tax was claimed. Right. If there was no input tax claim, no need to deem because normally these are goods given free. Normally it's not a supply. The only reason why we are asking the supplier to account for deemed output tax is because there was input tax claim in the first place. If no input tax, no need. All right. So by right, if A had claimed the input tax, A must go and account for deemed output tax. But A can also choose not to claim, so it doesn't need to deem. All right. So the second option is the correct answer. Right. The first one is not correct, yeah, because the first one say A must account regardless of whether he had claimed. No, if never claimed, no need to deem. All right. Yeah, there was a clarification just now. by Chua Siu Kian, right? The customer provide the, the second question, right? On the export, right? The customer will still provide the export document later. Does it cannot treat as zero rated supply? The straight answer is cannot, right? Because the supplier has to determine zero rating, right? At the point of sale, at the point of the transaction, right? The documents will only come later, 60 days later, right? That's why that is the document part, right? Is really for you to support this transaction that happened earlier. That's why you must have the documents, but we give you time to go and gather the documents. But it's at that point in time, at the point of transaction, the supplier must have certainty. The documents will not come in yet, right? So at that point in time, the supplier must decide whether am I absolutely certain that the goods will be exported, right? And from IRA's point of view is we gave these few scenarios only where we say these scenarios you can be certain, but make sure you go and get the documents later within 60 days, right? In the case where, so GST is self-assessment lah. To be very honest, if the supplier choose to zero rate, right? And actually manage to get the document 60 days later, sometimes we may not know also. But this is the at your own risk lah, right? But let's say based on the last scenario, based on the scenario itself, if you ask me whether can or cannot, we say cannot. It's very risky for the supplier, especially this is an overseas customer. The customer can promise you all they want, right? I promise you, I'll give you the documents, don't worry, I'll export out the goods and all that. But at the end of the day, if the customer cannot get they cannot provide the documents, right? It's the supplier who has to fork out of pocket, right? For Nelly's question, the last question, since the value of the gift is above 200, does it make a difference in terms of deemed supply? I don't really know what you mean. Don't really get it. Do you want to clarify?
Hello. So I guess
Hi.
because in one of the slides there's a mention that the exception for deemed supply only applies for gift above less or equal to $200. So I'm just a bit confused that in the pool question, because the value of the gift is $300, why are they able to choose the option 2 instead of option 1? Yeah.
Okay. Maybe I clarify this point of confusion. So basically, right, what we are saying is if the gift is below 200, even if the supplier had claimed the input tax, it doesn't matter. They don't need to deem. Okay, so below 200, no need to think about deeming at all, even if input tax was claimed. All right. But if the gift is above 200 and input tax was claimed, then they must go and deem. All right. But if the gift is above 200, input tax was not claimed, then no need to deem. Does that make it clearer? So deeming only occurs if input tax was claimed and gifts above 200.
Okay. Thank you so much. Thank you.
All right. So hope that's clear. So I'm so sorry if that wasn't clear earlier. Yeah. Thank you. All right. Okay. Thank you so much, everyone, for participating in the poll. Okay, I think let's move on. All right. We'll move on to the input tax. All right, so I'm now at the input tax claim. All right, I think we have about, this section should be a bit shorter. So I think, yeah, hopefully we can do it quite fast so that we have time to practice on a couple of case study questions. All right. Okay, so for input tax, right, this is the claiming. So all the while, the whole morning, we've been talking about charging, and what rate to tax and how to classify your supplies, right? This is now about the claiming. All right, so at the same time, while we ask GST registered business to charge, we also allow them to claim GST on their business purchases and imports, right? And common input tax are those where the GST, they purchase on goods and services for the business or for overheads, right? Right, so the input tax provision is under section 19. This is in the Act. Okay, so section 19, you have part 1, part 2, 3, and I think until 5 that talks about input tax claim. All right. So at the end of the day, GST, that's why in some countries it's also called value added tax. At the end of the day, right, we look at the net value added. Right. On one hand, the business charge GST, right? That's the output. And then on the other hand, they claim GST, that's the input. So at the end of the day, when you file your GST return, right, we are looking at the difference, right? If you have more output than input, then it becomes a net payable, right? And that's the amount that they actually pay to IRAS. All right. If the output is less than the input, that means there's more claims than the input, than the output. Then it will become a net refundable. All right. That's when we make a refund to the GST registered business. All right. So it really depends on the from quarter to quarter, it could be quite different as well. So it really depends on timing. All right, because it could be a case where you purchased in this quarter, right? You claim in this quarter, but the sales only happen next quarter. So this quarter will be a refund, next quarter will be a sale. It's also possible. It can also be, you make a huge purchase, for example, this quarter. Another common scenario where, a business is always in a net refund position, exporters, right? Because exporters, let's say you buy all the goods, right? You import the goods, you have a lot of import GST, right? So you claim as input tax, right? And then when you export out the goods, the output tax is zero. Remember, it's zero rated supply. So you're always in a net refund position. It's also fine. All right, as long as that you apply the GST rules correctly, we don't. Yeah, it's actually okay. It's fine either way. All right. At the end of the day, right? I think what we're trying to achieve is we allow input tax claims so that for a fully taxable business, GST must be neutral. That's a very fundamental principle. When we say GST neutral means that the business should not be absorbing any GST, right? Whatever you buy, you can claim. You don't need to fork out of pocket. Whatever you sell, you collect the GST from your customer, right? So again, you don't fork out of pocket. That's how you ensure neutrality. It's only neutral to fully taxable business. Okay, just now we talked about exempt businesses. It's not neutral, right? Because exempt businesses, you're making exempt supply, you cannot claim your input tax, right? That's more from a policy angle, right? At the end of the day, ultimately GST should be payable by the local final consumer. So like us, when we buy goods, right, we are the ones paying the GST, and then it goes upstream to the wholesaler, distributor, and so on. Okay, so for input tax claims, there are quite a few conditions to be satisfied. We'll be going through one by one. This is important, right? So you especially on what we call disallowed input tax claim. There are certain input tax claims that, even if you meet the other conditions, we still don't allow you to claim, okay, for policy reasons. All right, so I think we will spend some time on this. All right, so for input tax claim, because the business is claiming from IRAS, right? So we tend to, definitely we will scrutinize a lot more and we are very strict in terms of allowing input tax claim, right? So the business must ensure they meet all the conditions, right? The first one is pretty easy, okay? The GST incurred, all right? The goods or services must have been supplied to the taxable person, all right? And then or must have been imported by them, all right? So basically, right, if you are buying goods, or you have a contract for a service, right? You must be the contractual party. All right. If you're buying goods, you must be the one buying it. All right. If it's not even your goods, you don't buy it, then we cannot be allowing you the input tax. All right. For imports, you must be the importer on record. All right. Only then we allow you to claim. All right. And then the next condition, we say same thing like charging. The goods or services must be used or will be used for the purpose of your business. All right. Basically, if let's say the input tax is incurred for non-business activity, right? For example, the goods or services are used for private reasons, then we cannot be allowing the input tax, right? For example, say if let's say the goods or services are used for free activities or philanthropic activities, right? Because these are free, they are non-business per se, they are held for other reasons. We also don't allow the input tax. Right, so the first two conditions are pretty straightforward. What is probably a bit more complex for businesses which are partially exempt, right? Meaning you make a combination of taxable and exempt supply, right? Is probably this condition where we say that to claim, GST must be incurred for the making of taxable supply. If you only make standard rated and or zero rated supply, very straightforward, can claim everything. Okay, just meet the other conditions lah. Still must have documents, must be for the purpose of business and all that, right? But if you are making some exempt supplies, if input tax is directly attributable to the exempt supply, it is not claimable. All right. So for example, you incur, say, legal fees. Okay, so for example, someone who wants to rent out a residential property, you incur legal fees to rent out that residential property, a bare residential property, right? Because the residential property is exempt, and the legal fees is directly for this rental of residential property. Then the input tax is not claimable. Straight away cannot claim. All right, but let's say it's residual. Residual are things GST incurred on general overheads. So you make supplies, right? And then we will allow you to claim a portion of the input tax incurred, right? The partial, this is what we call the partial exemption rules. That again, there is an e-tax guide on this. Okay, I mentioned this. GST partial exemption and input tax recovery. There are many rules, right? By and large, for normal businesses. Okay, just now I mentioned, right, it's very common for normal taxable business to also have a bit of exempt supply. So things like common ones will be interest income from deposit or money, or foreign exchange gain or loss. You know, this kind of exempt supply will occur in your normal course of business. Right. So for this kind of businesses, they don't need to worry. Right. Basically, even though you have become a partially exempt person, but we do have some straightforward rules, right? For example, there's this rule called de minimis rule in Regulation 28. Right? This is the GST General Regulation. Basically, it says that if the exempt supply is of a low value, right? For example, 40,000, not exceeding 40,000 a month, or it's a small percentage of your total supply, right? Then if you meet this rule, you straight away can claim everything. You don't need to apportion. Right? Or if let's say all your exempt supplies are, okay, so we have this regulation 33, which mentions certain kind of exempt supply that is incidental to taxable business. Basically, we're saying that everything, this regulation 33, right, taxable business will also make all this, right? Not just a financial provider. So if all your exempt supplies are under this regulation 33, like you only have interest income, or you only have foreign exchange gain or loss, then again, you can claim everything, all your overheads, subject to the normal other input tax condition rules. You don't need to do this apportionment at all, right? So for a taxable business with some exempt supply, it should be quite straightforward. All right, they usually can claim everything, just ensure that they meet some of these exceptional rules. Okay, the complication comes for businesses who make a lot of exempt supplies. So these are typically our financial service providers, our real estate developers. Okay, so for these businesses, the rules are a lot more complex. They can claim, usually they will claim some residual input tax, because they cannot claim a lot of things, right? All the direct input tax directly for exempt supply all cannot claim. So for these businesses, they do make some residual input tax claims, and it can be quite substantial given if the business is quite a large business, right? But they do follow quite a set of complicated partial exemption rules, right? So if you want to know more, all right, or if you are, you are representing a client or you're from a company with such scenarios, please refer to the guide, right? That's too complicated to be covered in this basic module, so I won't touch on that. All right. Then most important, input tax claim must be supported by a valid tax invoice. Okay, what do we mean by valid tax invoice? Right. So any standard rated supply. Okay, so you only claim when there's GST. So that means from the supplier angle, right, the invoice must have been a standard rated invoice. If not, you as a customer have nothing to claim. Right. So from the supplier angles, this is the supplier's responsibility. He must issue a valid tax invoice with a lot of details that we need. Right. That's not, this morning I mentioned example, right? They must show the GST registration number. So even if the GST registration number for companies are actually the same as the UEN, but we still require them to show one line that says GST registration number, this number. Even it's the same number, we still need them to show in this line. All right. Valid tax invoice has many other requirements. For example, we also need the supplier to show the breakdown. So they must show what's the amount before GST, what's the GST rate, the GST amount, and what's the amount inclusive of GST. Right. So you can go through either in Regulation 11 or on our website. Right. There is a sample there that shows what we need of a valid tax invoice. Right. Only if the customer have this valid tax invoice, they can make the claim. Right? If they say the customer want to claim, right, then realize certain details are not there. What the customer need to do is to go back to the supplier and say, can you rectify your invoice? Can you issue me a proper tax invoice? Right? For zero rated supply, it's okay. For any other kind of supply besides standard rated, they can just issue a normal commercial invoice. We do not regulate commercial invoice. Right? We only regulate tax invoice because it's for the purpose of claiming input tax. Right? If the input tax claim is in relation to import, right, then the claimant must also have the import permit showing the name, and all the GST breakdown and so on. All right, and then just to note that let's say the tax invoice is in foreign currency. So for example, if you're trading, in foreign currency, from a customer perspective, right, the customer can only claim input tax based on the SGD equivalent that is stated in the invoice, right? So the supplier, for example, if the invoice is in foreign currency, right, the supplier has the obligation to show the SGD equivalent, right? The supplier can choose to use one of the published rates, for example, Singapore Customs. So these are acceptable rates, Singapore Customs rates, the exchanges, MES rate, right? The supplier can use those exchange rate, convert it. So the supplier must show the SGD equivalent in the tax invoice. Then the customer, as the claimant, can only claim based on that. Right? So even if the claimant has its own, let's say a customer, right, a big customer may have their own in-house exchange rate, or they use a different basis, and the exchange rate may be different slightly. Okay, the customer still cannot do that. They cannot convert on their own and then claim based on their own in-house rate, right? Customer must always claim using supplier's exchange rate. Okay. All right. Right. And then we come to disallowed input tax claims. Right. So this one is important. Okay. The disallowed input tax claims. Okay. These are what I mentioned. Even though you meet all the other conditions, there are certain expenses that we are specifically blocked. It's spelled out in regulations 26 and 27. The input tax is not claimable regardless. Right. There are about 5 categories of such expenses. The first one is club subscription fee. So club subscription fee are those, say, country club, they charge the subscription fee, joining fee, okay, by any sport and recreation club, right? Any such fees is not claimable, right? No matter what, they are not claimable, right? But let's say country club charge you green fees, buggy fees, those are claimable subject to meeting the other condition. Like, for example, it must be for business purpose and so on, all right? But club subscription fee not allowed. Yeah, then the next one is what we don't allow is we also generally don't allow the claiming of medical and accident insurance premium for staff. All right, unless the insurance contract or any compensation under the insurance is obligated under WICA, Work Injury Compensation Act. All right, so we don't allow insurance premium because this is more of you buy insurance premium for the staff is to cover them personally. So it's more, there's a very strong personal element to it. All right. At the end of the day, if touch wood something happen, it's the staff or their families, who will benefit from it. So for that reason, we don't allow, right? Because at the end of the day, input tax claim is for business purpose, but that one has a strong personal element, so we don't allow. Okay, but unless of course it's obligated, it's already, and the company must take up such insurance under WICA. Okay, in the same vein, we also don't allow the claims for medical expenses for employees. Same thing, because of the personal element, all right, unless again it's obligatory under WICA, right? So obligatory under WICA can claim. Not obligatory under WICA, that means the company just providing it as like a fringe benefit or employee benefit, cannot claim. right, for medical expenses and medical insurance premium. All right. We do have a slight amendment that was done in 2021. This was during COVID lah. This is more for COVID related expenses. For example, if let's say that back then, right, if the employee had to go for swab test, say before he can travel for business purpose, he had to go for swab test, right? Yeah. So for those kind, even though it's really meant for the employee himself, but because it's on the nature of work, and is pursuant to COVID rules by the government and all that, we do allow the claim. Right. Then the other one, the more common one, the more prominent one would be, we also don't allow input tax claims for cost and running expenses of motor car. Right. We do allow for cost and running expenses for commercial vehicles. So if your company has a van, lorry, motorcycle, that used for the purpose of business, the cost and the running expenses can be claimed. But if it's a motor car, cannot be claimed. Right? So that's the general principle. Don't allow for cost and running expenses of motor car. Right? This is really based on the policy similar to income tax as well. Policy to discourage car ownership in Singapore. I think there's nothing. Everyone knows that there's quite a public policy reason, right? But over the years, we've made some exceptions, right? Because of not all the new developments, with all the private hire industry coming up and all that. So generally, we don't allow you to claim for a motor car. There are some exceptions. So for example, since April 2022, say if you provide, this is like, for example, airport limousine services, right? So if a company provide airport limousine services, then incur input tax, right, to transport the passengers, we do allow the company to claim, right? And then recently, I think in January 2023 this year, we also allow private hire car drivers. So the last one is on private hire car driver. So for example, we do have some say they are sole proprietor. That means they are already GST registered. You are sole proprietor. Maybe you have your own other business. Then you happen to on the side drive private hire vehicle. Right. So for those, we do allow you to claim the running expenses for your private hire vehicle. But bear in mind that with or without this, right, because you are already GST registered, when you provide the private hire services, you must charge GST. Account GST lah. You can't really charge, right, because it's through the app and all that, but you need to account GST, use the tax fraction to account to us. Right? As long as they are GST registered, as a sole proprietor, as long as you are GST registered, any other business you do, any other trade or vocation that you do, on the side, maybe if you're a real estate commission agent, you also must account GST. All right, we'll talk about this a bit later, but in GIS, right, for sole proprietor, we register the person, right, and not just the business alone. Right? Then the last few category, we also disallow expenses on family benefits, right? So for example, if the company, provide very good benefits, pay for, say, education for your staff children, right? Or maybe for expatriate staff children in Singapore, we don't allow, because that's for that benefits the family of the staff. Okay, it's not for business purpose, right? Then of course, betting, sweepstakes and all that, we also don't allow. All right, so that's for the disallowed expenses. Later when we do the case study, we can look into this a bit more. All right, then the last condition, this is relatively new condition. I'm not sure that you guys have heard about this missing trader fraud, or sometimes we call it carousel fraud lah. All right, so in recent years, this is public news, there's been quite a lot of such missing trader fraud lah. This kind of fraudulent arrangements to, basically defraud the government of the GST amount, right? And so as a claimant, okay, you all can go through this later, how the fraud really works lah. And then you can also see some of the, some of the cases that we have publicized, right? But in short, right, because this missing trader fraud, how it works is there are multiple parties in the chain. One person claim, one person claim, one person charge, one person claim, one person charge, and so on, right? But the fraud usually happen when one of the parties who's supposed to account to us the GST disappear before accounting. Okay, remember just now we say GST is always input, output, input, right? And by right is neutral all the way to the final leg. Right? But in a missing trader fraud, one party who's supposed to account to us claim already, but then didn't account to us. All right. So what we need to do is also make sure that we need to safeguard. While we cannot safeguard against that, while we try to detect fraud and all that, we also need to safeguard against everybody who's claiming along the chain. Right? Because everybody who's claiming, everyone just claim, but somebody who's supposed to account didn't account. Then there will be a net loss to IRAS. Right? So because of that, everybody along the chain who wants to claim, we need you to make sure that you, as a claimant, right, you need to have at least, you need to have certainty that the goods or services that you purchase are not part of such an arrangement. All right. And we expect you to take some reasonable steps. Remember, this fall back to GST self-assessment. You want to claim? Sure, got conditions to meet, right? You must take certain steps to ensure that your purchases are not part of such an arrangement. All right. There's a webpage, an e-tax guide on this. You all can take a look. But some things, just roughly basically, what we're saying is you must have a business sense. For example, you buy the goods, right, and you want to claim from us. It cannot be whatever is probably too good to be true. It's probably too good to be true. So you must have that alert. Then you must go and do some checks. Suddenly new supplier, can want to go and sell you a lot very very high value goods. Whether or they charge you very very high price, that kind. So I think you need to have that business sense to check whether is it legit or not. Right. But this should be part of any checks that any business should do. Like when you want to transact with a new supplier, right? You want to check that the supplier is, legit, the supplier is reputable and all that, right? So actually, we're not asking for a lot, right? It's just any reasonable checks that you do that you should be doing already as part of your business, right? So I don't want to go through too much into this, but basically, we need that business, the business to do that reasonable test lah. Right. So what we're saying is, as a business, you do this kind of reasonable test, right? Or you already suspect, but you close your eyes, then if that's the case, right, you are not entitled to the input tax claim, right? It's not a case where as long as you buy and you pay GST, you can claim. It cannot be like that, right? There could be implications upstream in the case of MTF arrangement, right? So what we're saying is, at the end of the day, as a business where you buy the goods and all that, you must know what you're buying. You must know it's legit. You must know your supplier is legit also. Right? And if you think that it's not legit, you would have questioned or you have taken some steps. Right? So don't just blindly pay the input tax, blindly pay the GST and then want to claim from IRAS. All right? So do some due diligence checks. Okay, so that's for the normal input tax claim condition. Right? So I think if I can go back, right? So in summary, these were the input tax claim condition. Usually, I think for input tax claim, some common issues that we often encounter is maybe business don't have the full supporting documents, don't have the valid document. So documentation is a common issue. Like I said, attribution is not really an issue unless you are exempt. You have very high or substantial exempt supply. Right. The other one is to take note of is disallowed input tax claim. Right. The disallowed input tax claim is not new. It's been there from day one, but we still have businesses making such mistakes, claiming on motor car, claiming on medical and all that. Right. So those are the things that definitely we will be checking, right, when you submit your GST return. Right. So that's talking about the normal input tax claim. Right. That's for, when you're GST registered, every quarter you want to claim, those are the conditions you need to meet. Right. On top of that, okay, so one of the condition for input tax claim is you must be GST registered, right, before you can claim. Right. But usually in your when you first start your GST registration, you could already have certain goods or services that you purchase before your GST registration. Right. So this is what we call pre-registration GST. right? That means these are purchases you make before your date of registration, right? We do allow you to claim under certain scenario. This is like an exceptional claim, right? We do allow you to claim under a certain scenario, right? So for example, if you incur pre-reg GST on goods, right? If you acquire it within 6 months before your registration, and you still have it on hand, right? We will allow you to claim, okay? Provided that you don't sell the goods yet, right? So for example, so you buy raw materials, right? You buy raw materials before your GST registration, but within 6 months. And then you use the raw materials to make your goods. Okay, as at the date of your registration, if the finished goods are still on hand, you haven't sell anything, right? You can still claim. But let's say you already use the raw materials to make the finished goods, and the finished goods are already sold before you are registered, then you cannot claim. Why? Because you sell the finished goods before you are registered, right? That means when you sell, it has no GST, because you cannot charge GST before your registration, right? So since you didn't charge GST, you also cannot claim lah. All right. So basically, for goods, right, what we are looking for is you cannot have onward supplied the goods before your GST registration. Okay, there's some slight differences in the rule between before 6 months and more than 6 months, but largely I think that's the main criteria you need to remember, right? It's really about whatever goods you buy, you want to claim, are they still on hand or not, whether in the original form or in the finished goods form. All right. Of course, for pre-reg GST, you need to satisfy this condition on top of the normal input tax condition that I mentioned earlier. All right. So still same thing lah. Pre-reg or not, right? Car, medical, and all that still cannot claim. Okay. We also have another pre-reg GST rule on specifically for rental, utilities, and services. Right. So same thing like it's very similar. Basically, as long as within 6 months, and it's not directly attributable to supply made before registration, we allow you to claim. So for example, say you are you incur property rental, right? So if you incur property rental within 6 months, and this is for your own office, then you can claim. Okay, you can claim when you are registered lah. You cannot claim before you're registered. Only when you are, so once you are GST registered, in your first GST return, there is a question. I can't remember which line item. At the bottom, after all the boxes, it will ask you about, are you claiming any pre-registration GST? Right? So this one is only an option for your first GST return. Right? So just include it together in the first return. Right? So just now I said about rental, right? So if you incur rental within 6 months, it's for your own office, you can claim. All right? But if you incur rental, and then actually you are a rental company, property rental company. So you go and rent from your landlord, and then you onward rent to other parties. You onward rent before your registration, right? And then you cannot claim the rental already because you already make the supply before registration. Can you? Okay, that's what I mentioned earlier, right? Okay, so we usually use 6 months plus minus. There's some slight differences between the 6 months and not, right? But the rules are similar. Basically, if you already onward supplied, okay, whatever that you're purchasing, you already onward supply it before registration, you can't claim. Okay, so that will wrap up the claiming portion. Right, the last two bits, right, the last two section is, I'm just going to touch briefly on the imported services and low value goods, and then we'll talk a bit about registration rule, and then that's it. Then we'll do the case study. All right. So this was a series of changes. In short, we can call it the imported services and low value goods regime. Right. This was a series of changes that we introduced from 2020 onwards, with the latest amendments made from Jan 2023 this year. All right. They do not affect all businesses at large. Okay, it's really quite for certain businesses that are in the what we call the digital economy lah. They will affect businesses more in those areas. All right. The rationale. So in the past, when you buy services locally from a local business, you buy services locally, there will be GST if the supplier is GST registered. And often they are lah, because they are local businesses. Right? So you pay GST on local services. But when you import the same service from an overseas supplier, you don't pay GST because the overseas supplier is not registered. So it creates an unlevel playing field, and it may disadvantage our local businesses here, right? Because our local service becomes more expensive compared to an overseas service, right? So to level the playing field, and because, over the years, especially during COVID and all that, the digital economy really grow a lot, right? We implemented what we call, so there's two mechanisms here, reverse charge and OVR. Okay, reverse charge, just remember, reverse charge is for B2B, right? So if as a business, I buy imported service, yeah, right? So as a business, okay, I buy service from overseas supplier, right? And or else I buy low value goods. Low value goods meaning those 400 or below, right? As a business, if I do that, I need to apply reverse charge, right? Only if I'm someone who cannot claim in full, right? So how does reverse charge work? Okay, reverse charge is by the name, it means that you are doing reverse charging. So normally, right, you sell goods, you charge, then you claim for the purchases you make. That's in the normal stream of things. But under reverse charge, right, the person who is receiving, the recipient, will also charge, will also account. So in GST return, right, for example, if I'm a business, I'm a reverse charge business, I buy, let's say, $100 of imported service. Okay, and then I incur $8 GST, right? What I will do is I need to account for $8 as output tax in my own GST return. I'm the recipient, yeah, but I'm accounting $8 as output tax. At the same time, I can claim the GST amount as input, which is normal. This is the normal. As a recipient, normally I can claim, right? So I will claim $8 also as input tax. This is what we call reverse charge. Right? Then you may ask me, but this one, right, is net zero, right? Then what's the point? Yeah, so precisely the point. So because of that, right, reverse charge doesn't apply to everybody. Okay, it only makes sense to apply reverse charge to, right, businesses that cannot claim input tax in full. So again, our partially exempt businesses, or maybe those with non-business receipts, charities, and all that, right? Because for them, then it makes a difference. Maybe I account GST $8, I only can claim $2, right? Or I cannot claim at all, right? Depending on what kind of supplies they're making and all that. So then net, there'll be a payable amount. All right. So reverse charge is only applicable to this group of businesses. If you are a fully taxable business, you don't need to do reverse charge, even though you are buying services from overseas supplier, because the net effect will be zero. All right. Of course, if you're currently not registered, all right, but you are this kind of business and you are procuring this kind of services exceeding 1 million, you still need to register and then do reverse charge. Okay, that's similar to our normal registration liability rules. All right. So, and reverse charge only makes sense to apply reverse charge on services that would have attracted GST in the first place had they been supplied locally, right? So if the nature of service is already exempt, local also exempt, right? Then overseas, there's no point to apply reverse charge on it, because the basic principle is reverse charge only for leveling of playing field. Right, so again, I won't be going through in detail, but roughly that's how it works. All right, so reverse charge in 2020 is started from imported services. All right, and then this year onwards, such businesses also need to do reverse charge for low value goods. All right, so that's for reverse charge. Then the other regime that came in under the digital economy changes are what we call OVR, Overseas Vendor Registration. Right, so this is for B2C. Right, because just now reverse charge, right? Because the recipient is a business and he's GST registered, so we can make them do all these things lah. In essence, to collect and account the the GST to us. But for a consumer, we can't possibly be imposing such rules on consumer and expecting consumer to voluntarily be paying the GST, right? So for consumer, for the same kind of service and goods, the collection mechanism is through OVR, meaning we register the supplier instead, right? So we register overseas supplier, right, as well as electronic marketplace operator, right? Because a lot of these overseas suppliers, sometimes they don't sell the goods directly. They go through electronic marketplace operator or redeliverers lah. So like your platforms, these are basically your platform operators. Whether you call it like Shopee lah, Taobao, right? Yeah, in the past when we started digital services, we had suppliers like Netflix and all that. So in other countries, this is called, back then this was called the Netflix tax. All right, so we register the overseas suppliers if they meet certain condition. All right, and they will collect the GST for us, okay, on services. So last time when we first started, we differentiated between digital and non-digital services. Now it doesn't matter lah. Basically, any imported service or any imported goods that's 400 and below. All right. So everything, as long as the supplier is registered under the OVR regime, all right, the supplier must charge an account for GST. Okay, but this is what I meant just now. Like, sometimes you can't really tell because they will just include the GST inside the price of the goods or services. Okay, so I talked about LVG already, right? So low value goods, right? So it depends. If it's a B2C, it's OVR. If it's a B2B, it's via the RC regime. All right, that's all I'm going to say about RC and OVR. The rules are very complex, so please read the guide if it's applicable to you. Now that I finished the topic, right, then I say, okay, so we won't be testing on reverse charge and OVR lah, because it's pretty new and they are very complex rules. All right. Okay, turn touch and go on import GST suspension scheme. You just need to know that there are various schemes that we have to suspend import GST on goods, right? So it really depends on the businesses, what kind of business they have, what kind of business scenario, and if they meet the conditions under the respective schemes. All right, the most common schemes would be MES, Major Exporter Scheme. This is for the general exporter, right? Because why do we have all these schemes, right? It's really to relieve cash flow. So a lot of businesses in the import and export industry, when they import in or they purchase, they have to pay GST, right? But at the same time, when they export, they don't collect GST. While that is a good thing, it also means that they don't collect the GST to roll over. So from a local, if you're making local sales, it can also be I buy, I claim, and then at the same time, when I sell, I collect GST, and I use that GST that I collect to roll over first for my next purchase, because GST filing is typically every quarter, or in some businesses case every month, and then they still have to wait for a refund from us, right? So there is this time lag where such businesses, especially those who are exporting goods, they may face cash flow problem. So with that in mind, we introduce various schemes to help them, such that in the first place, when you import, your GST is suspended. So you don't have to fork out the cash flow upfront, right? You need to meet certain conditions and all that. Right, so I won't be going through. If you want to read on the schemes, there are various e-tax guide and web pages for every single scheme. Right, and then the last bit that is important is on GST registration rules. All right, so I think we also mentioned some of these earlier already. When is a person liable to be registered for GST? Right, so we mentioned, right, only GST registered business can charge and can claim. If you are not GST registered, you can't do either. Right, and to determine whether you are registrable or not, whether you are liable or not, we look at your annual taxable turnover. Right, so annual taxable turnover means standard rated and zero rated. Okay, but it excludes exam supply that qualify for zero rating, out of scope, and so on. All right, so GST registration has two sets of rules. Right, one is if your annual taxable turnover exceed 1 million, it's compulsory. You don't have a choice. Okay, it's compulsory for you to be GST registered. Right, but if your annual taxable turnover is less than 1 million, you don't need to register. Not liable, but you can choose to be. Okay, of course, if you're voluntary, there are more conditions for you to meet. Okay, so for GST registration, we look at your annual taxable turnover. In the past, it used to be on a rolling quarter basis, which can be quite cumbersome for businesses to monitor. Right, since 2019, we have used calendar year. Right, so basically we look at your annual taxable turnover comprising of your standard rated and zero rated supply for 1 calendar year. There are two ways of looking at it. One is looking backwards, retrospective view. So at the end of every year, okay, all businesses must monitor and check what is their taxable turnover for that past 1 year. Okay, if let's say on 31st December and you look back 1 year and you realize that actually your taxable turnover already exceed 1 million, okay, you must straight away come forward to apply for GST registration. That means you are liable already. This is the retrospective way. Okay, so every business in Singapore must do this every year. Right? At the end of every year, look backwards. Okay, we also use calendar year at the end of calendar year so that it's easier. It's a reasonable milestone for businesses to monitor their turnover. Okay, so that's retro. Right? Another scenario will be prospective. Okay, sometimes when you look back, maybe you haven't exceed 1 million. Okay, then you go on your business, right, for the next 1 year. Then in the middle of the year, you suddenly get a big contract. And then that big contract alone will make your turnover for the next 1 year to be more than 1 million. Right? For example, you sign contract, you accept a PO or if a quotation, more than 1 million. Okay, so if that's the case, then you already have certainty. You already can reasonably forecast you will exceed 1 million in the next 1 year. So what we are saying is, if that's the case, you are also liable. This is prospective view. Right? As long as you sign such a contract, you know already you're going to exceed 1 million, you must come forward for registration. Right? Okay, so then does it mean that every time you hit 1 million, you must come forward, then must register, must register? To be prudent, yes. All right. But for example, let's say the business also, okay, I already hit more than 1 million this year. Today is 31st December. I know I already hit more than 1 million. But I think this is a one-off only. Okay, for example, I had a very big project last year. So I know that's why I exceed 1 million. But next year, my normal steady stream, my business as usual turnover is very little, 200K only. So if that's the case, if the business is very, very certain that's the case, then they can choose not to be registered. Okay? Or for example, if I know I'm closing down next year already, I already exceed 1 million, but I know I'm going to cease business already. Then if that's the case, you know for sure you will not exceed 1 million in the coming year, you can choose not to register. All right? The only thing we caveat is you must be very, very certain right? Because if let's say you think you will not exceed 1 million, but then really you exceed 1 million again at the end of the next calendar year. So what happens is we will backdate your registration all the way, right? From the time that you first hit your 1 million. Basically, we're saying your forecast cannot make it you didn't have that certainty in the first place. Right? Then when we backdate all the way, the issue is always because we backdate you. So we need you to account the GST all the way back. Then the issue is whether are you able to recover the GST from your customer or not. Or if your customer is not willing to pay already, or maybe your customer also gone already, then you have to fork it out of pocket. Right? So that's the very painful part. That's why we always urge businesses, monitor at the end of every calendar year. If you are not sure, you already exceed 1 million one time, and you are not sure what's going to happen the future year, just come in and apply for registration. Okay. Okay. So then GST registration rules differ slightly depending on your business constitution. Company very easy. Okay, I start from the last one Company is very easy. Company, we just look at the company itself right? We just look at taxable turnover that company. Unless there are some companies who own multiple SP. SP is sole proprietor, right? Unless some companies they own multiple sole proprietor business, then we look at the aggregated, right? But most of the time for a company, a single company, we just look at the company's turnover only. All right. For partnership, it's slightly more complicated, right? Because, for example, while we register the partnership firm, we actually because partnership, right, actually is not a legal entity from the aspect of the law, right? So for partnership businesses, while we do register you in the name of your firm, actually the one we are registering, right, is the composition of partner, right? So we need to do aggregation of the taxable turnover of all partnership businesses with same composition of partner. So what do I mean? So if I say I have A, B, and C, 3 partner, A, B, and C, they own business 1, partnership business 1, partnership business 2. All right. What we will do is we will aggregate together partnership business 1 and 2 because they are both business is owned by A, B, and C. Exact same composition of partner. All right. And then if we aggregate together more than 1 million, then they must be registered. And then both partnership 1 and 2 automatically will be GST registered. All right. And then let's say A, B, and C are later go and set up another partnership. Then that last partnership is automatically registered also. Okay, they just have to come forward and then we will issue the GST number, right? Based on the partnership number, right? But it's automatically registered because it's the same composition of partner. All right, but let's say, right, partnership 1 is A, B, and C. Partnership 2 is A and B only. Then the composition of partner is not the same. It's not exact same. So we don't aggregate. We will look at each partnership business on its own to determine the 1 million threshold. Right, so that's for partnership. Okay, for sole proprietor, this is just now the example we talk about the private hire vehicle. All right, for sole proprietor, we register the person, not the business. So one sole proprietor, he can own multiple sole proprietor business. He can also have any trade, any vocation, any profession on the side also. Right? So what happens is we will aggregate everything under the person to go and compute the 1 million turnover. And let's say once this person is registered, any other business is set up in future, any other trade he do in future will all be subject to GST because by default is GST registered already. All right. So this is again for sole proprietors. This is a common confusion. No, the misconception is we register by the ACRA business, right? Because they set up multiple business with ACRA, right? No, right? You can set up multiple business with ACRA, that's fine, but we register you as a person. Okay, so when to apply for registration? Okay, so from the minute that the liability arose, just apply within 30 days, right? Then this talks about, when is the date of registration, yeah, in short, it's like roughly about a month after lah. Okay, this one is something that IRAS will fix. Of course, the business can, when they submit the application, right? If they want an earlier date, they can let us know if they want to register earlier. But if not, it's a default date. Okay, we'll go through this. Right. So just now we talked about liable businesses. So you exceed 1 million in the past, or you think you're going to exceed 1 million in the future, right? Then that one you must be liable for registration, right? But what if you are nowhere near 1 million at all? You are steady stream, you make taxable supplies, but your turnover is not as large. You don't achieve 1 million, right? You can still choose to register on voluntary basis. Okay, it's really up to the business. They can apply for voluntary registration. But because it's voluntary, there are certain conditions we impose. Like they must do e-learning courses, they must be on gyro. You cannot frivolously, come in and out of registration. Must be remain registered for at least 2 years. Right? Why do businesses want to do so? The main reason is usually to claim. Because if you're not registered, you can't claim. Right? But as a business, when you buy things, you purchase goods and services, you still need to pay GST. Then it becomes part of your business cost, whether you can pass on to your customer or not. So usually for voluntary registrants, we know the main reason they come in is really to claim. That's the benefit. Okay, the cost side is they need to consider that, once you're registered, you need to achieve a certain level of compliance. You need to, make sure that you can file your GST return on quarterly basis. If you do not have the expertise, you may need to engage someone to prepare your GST returns and so on. Right? You need an accounting system. You need to make sure you issue proper invoice and so on. All right. And last bit, okay, so just now we talked about registration, when you can come into the net. Now is when you can exit from the net, right? So basically, again, this is a choice. Businesses self-apply. Okay, at any time when you think that you are no longer going to make taxable supply, or you cease business already, right? Or you think that previously you came in because you more than 1 million. Now your turnover dropped already, going to be less than 1 million. All right, you can choose to deregister, cancel for registration, right? Just have to submit the form. Yeah, and then just remember, once you are deregistered, you cannot collect GST anymore. And we talked about just now about the deeming of output tax on any assets you have on hand. Okay, and that's it. And with that, right, I think we have completed all the slides and all the key topics. My intention is to run through two case study questions. The case study, the questions are in the slide deck as well. They are pretty long though, so I think my intention is to maybe we can take a break for a short break while you all also during the break, maybe what you all can do is try to look at the questions. If you can attempt the questions, good. If you cannot finish attempting, never mind. At least read the questions. So at least when we go through, everyone will have some context, right? But before that, let me see the questions you all have, right? Okay, let me just run through, yeah. So for some of you also, if you want to concurrently, you can also take a look at the revision questions, right? From JC, the question, for air tickets incurred by employee through self-booking, what documents do you need to declare zero-rated input tax? Zero-rated input tax. Okay, so in this case, it's air ticket, right? Do not have GST, zero-rated, right? There's nothing to claim, right? So it doesn't come into input tax. You don't put this into your input tax claim at all. You don't? Okay, so for zero-rated purchase, like in this case, the zero-rated purchase, you need to put the value inside box 5. So box 5 is taxable purchase. So it comprises of standard rated and zero-rated purchase, the purchase amount. The input tax claim is in box 7, right? Box 7 is the exact GST amount you're claiming. So in this case, you only need to put in box 5, right? A copy of the booking, any invoice, any receipt issue will suffice. Yeah, but air tickets is just straightforward lah. I mean, Singapore don't sell domestic air tickets, so it's okay, right? But there's no input tax claim. Okay, then next question from Agnes. When calculating the valid tax claim, under de minimis rule, does the company need to first exclude those input tax be attributable to the Yes, correct. So to answer your question, yes. So as long as there are input tax that is directly attributable to exempt supply, that one is under the condition for input tax claiming. You can't claim. If it's directly attributable, you confirm can attribute, you cannot claim. All right. The minimis rule, right, is to take care of all the other input tax, all the residual that you cannot directly attribute. So everything, whatever you can directly attribute to taxable supply can claim. Directly attribute to exempt supply cannot claim. Everything else cannot attribute, go into this pool and then apply the de minimis rule and so on. Regulation 33 and so on. Okay, JC also have another question on GST incurred on pre-employment checkup. Can GST be claimed? Yes, because the Regulation 26, when we disallow medical expenses, is for your staff. The wording of the law is based on your staff. But pre-employment means the person is not your staff yet, correct? That's why you are sent them for pre-employment checkup. So yes, technically, yes, you can claim, subject to meeting all the other input tax rules lah. Okay, from Shutong, company can also proprietorship. Yes, they can. What if they complete their account in March and their accounts are for FYE? Okay, so we know that companies will need longer to finalize their account. All right, but the GST registration rules, so basically, right, we don't need you to finalize your account for you to be able to tell us for sure whether you meet 1 million or not. All right, but you do need to have a sensing lah. So that means you don't need to finalize the audited account and all that. But you need to know whether roughly in this year, right, do you exceed 1 million or not? Right, based on because I think we do expect companies, don't wait until your financial closing. on month-to-month basis, so a regular basis, you should be monitoring your turnover. It doesn't have to be very, very precise. If you think you are near the 1 million threshold, right? Actually, our suggestion is if you cannot finalize your account yet, but you think you are very near 1 million threshold, come forward to apply for registration anyway. Because usually businesses which are quite near the 1 million threshold, right, it's really a matter of time before you hit it. So for prudence, our suggestion is for you to come forward to apply for registration. Right? For GST registration purpose, we don't need finalized or audited accounts. Okay? It's really based on your self-assessment. Right? Of course, if you, so maybe on and off when you apply for registration, let's say you claim you hit 1 million. And then when we look at your nature of business and all that, we may have some doubts, we may have some clarification. Then maybe we'll call for some documents or something to substantiate that you are near 1 million. Right? But we don't need the audited or finalized accounts per se. Question 2 of the poll just now. Okay, question Vivian, right? Question 2 of the poll just now, if I recall correctly, right, is the company, a local company sell goods to overseas company, but then the overseas company instruct them to deliver the goods locally. All right, so I mentioned just now, basically to zero rate. So zero rating is a relief. If you are not sure you can zero rate, you can standard rate. No one's going to blame the supplier. In order to zero rate, the supplier must check two things. He must have certainty that the goods will be exported. So if the customer take the goods or ask the supplier, please deliver the goods to my local so-and-so in Singapore, the supplier cannot be sure that really the goods will go out. This is what we call they don't have certainty. There's a risk here. So we say this scenario not permitted. This scenario, we will tell the supplier, you should standard rate. Even though to its overseas customer, maybe your customer may make some noise lah. Your customer may say, I overseas, you charge me GST, I cannot claim. Yeah, if that's the case, then by right, the business arrangement should be the supplier can arrange for the export himself. If the supplier arrange, he has certainty. If the supplier deliver to a local place, right, after that, the supplier don't know what happened, no more custody and control, right? Deliver already, then that's it. And only have the customer's promise will give you the documents. Not good enough. All right. So for zero rating, we are very strict on the certainty and on the export documents. Okay, so that's why in that scenario, it's standard rated. As long as deliver to anywhere in Singapore on customer instruction, will be standard rated. Okay. Okay, the exam format, right? The last question from Xiao Fang. Yeah, that's why I wanted to go through the revision question. Yeah, because I think the revision question will give you a flavor of what the exam is. It's quite similar. The format will be quite similar. All right. Exam topics, I think, so maybe we take this later after we go through the revision question. Then I just give you a quick wrap up. All right. So I intentionally chose 2 revision questions that I think will be more applicable to you guys. Right, that's why the study guide actually have 5 revision questions, but we're only picking 2 due to time constraint, as well as because it's a quite give you a good flavor of the exam question. Right, can I suggest everyone maybe just take 10 minutes until 12:30? If you can attempt the questions, please do. If you can't do it, never mind, please just help to read the questions. Then we go through together. All right. Okay, so 12:30, then we run through the questions and then we wrap up and that's it. Thank you, everyone. I hope you get a chance to view the questions so we can just run through. The exam questions will be quite similar in format to these 2 questions that we're going to be running through. All right. But of course, it won't be exactly the same lah, right? Okay, let me share my screen on the question and answer. Give me a while. Okay. All right, so I hope you can see this screen. All right, so in total, there are 5 case study questions. They are inside at the back of module 8 of your case study guide. All right, but I won't be going through all. Actually, the study guide already have the answers lah, so you all can go through there as well. But I think we'll just take this a bit of maybe 10-15 minutes to just run through these 2 questions. That's probably more relevant. right? And then see whether you guys have any clarification. So if you're not sure, why is the answer like that, please just shout out right now, right? So as we go through. Right? So the first question will be something like this, all right, where we will give you a business scenario, all right, and then telling you like, what kind of supplies and all that is being made by the company. All right. So like I mentioned just now, please be careful. Just take note of the periods that we mentioned, right? The quarter or the period where the transaction occur, right? By and large, they will be in from 2022 lah. So just take note lah for in case there are any questions, spending rate change and all that, right? But by and large, they will be occurring in the year 2022. All right. So typically, the question will have multi-part, right? It will ask you about, okay, so the first question will test you on claiming, okay, input tax, okay, whether is it on pre-registration or post-registration, that means the normal input tax claim, as well as accounting for output tax on different types of supplies and goods or services. All right. All right. So we will, okay, so in this case, we have this company, ABC, right, who is in the business of trading IC chips, right? And then ABC is registered from 1st Jan 2022. All right, so you need to advise ABC on whether it can claim input tax on various purchases and expenses, as well as the amount claimable, right? And then the next limb will be on the accounting of output tax. All right, right. So the first part of the question is on claiming of expenses incurred before GST registration. All right, so the first thing in your mind must be, okay, this is pre-registration GST claim. All right. The first part A, all right, it incurred corporate secretarial expenses on 15 December 2021. So that you are supposed to tell me whether is it claimable or not, right? You guys don't have to worry. This version with all the answers, I will later circulate through CPA and ask them to send it to you guys via email, right? It's basically the same question. I just inserted the answers below. All right. So for corporate secretarial expenses on 15 December, right, this was incurred within 6 months before registration. So yes, it's claimable. Right, this is a service, it's not onward supply, right? So good enough, you just tell me, yes, it's claimable and why. Okay, in this case, it's incurred within 6 months before registration. All right. Then next up, right? So basically, right, the question will also need you to tell me how much of GST is claimable. So in this case, for example, part A is very straightforward. No, they already give you the amount. They'll tell you GST is 105. There's nothing to compute. All right. There could be some question where you need you to compute. All right. Simple computation. Nothing very fanciful. All right. So part B, ABC also purchased office furniture in August 2021. Right. And to date, the furniture is in the office. Right. So in this case, you look at the dates, right? You know it's more than 6 months. So the question, what it should be in your mind is it claimable or not? It's more than 6 months. So what is the thing that we are looking for? Right. So first thing is it goods or service? In this case, it's goods. Okay. Then it's more than 6 months. So what do we need to look for? Okay. We need to make sure that it's not onward supplied or consumed, right? Before GST registration. So in this case, yes, claimable because the furniture is still in the office. It's not onward supply, right? If let's say ABC is a furniture company and it's a purchase furniture and then sell the furniture already, right, before registration, then it cannot be claimed. All right. Then part C, right, this is a purchase of inventory, okay, but every item of this inventory was sold by 30th September. Right? That means it was sold before GST registration. So the minute you see purchase something and sell something in the question, that should trigger in your mind about whether, oh, has the goods or been supplied before registration or not. If yes, in this case, it's yes. Okay, because the company was only registered in 1st Jan 2022. But every part of the inventory was already sold. Right, so therefore it's not claimable. Okay, and the reason is just keep it simple. Goods were supplied already, or the goods purchased were already supplied before GST registration. All right, like I said, sometimes it can be part. So for example, you buy raw materials and then you use it to make finished goods, and some of the finished goods sold before registration. Some may be on hand or sold after registration. That's where you need to do some simple computation, right, to say that actually what is claimable is the one that is not sold yet, and that's how much. Okay. Okay, any questions? You all just shout it out lah, because it's a bit hard for me to toggle. If you got any questions on this, you shout it out. If not, I'll just go on, yeah. Okay, the next part is on the purchases after registration, right? So then they will tell you, okay, this is for the purchases incurred in the quarter or from what date to what date, right? So the first part is on ABC purchase raw material costing this amount, right? And then there's a supplier's exchange rate and the ABC's own in-house exchange rate. Right, so purchase raw material for business purpose, yes, it's claimable. You need to mention that it's claimable, right? Then we need you to show the computation, right? How much you can claim. Okay, this is what we mean as a claimant. You only can claim based on whatever conversion, whatever SGD equivalent that the supplier states on the tax invoice. It cannot use its in-house exchange rate. So this is a common trick question lah. A lot of people think that use your own in-house exchange rate because you are the claimant. Cannot, okay? Must use the supplier's exchange rate. All right, so the computation, convert all to SGD equivalent. Okay, of course, when you state what is the GST amount in the exam question, you must state in SGD lah. Okay, part E is on ABC incurred brokerage fee of 1,000 and GST. Okay, remember we say brokerage fee is actually taxable supply, right? Right, so incur this to sell shares in another company. So the minute you see brokerage, shares, what must come to your mind is this for the making of exempt supply? The brokerage fee is taxable by itself. That's why the supplier charge GST. But for the claimant, right, you still need to establish whether this purchase, this input tax, is it for the making of exempt supply or not. So in this case, why are they incurring the brokerage fee? To sell shares. All right, so if selling shares is the exempt supply, therefore the brokerage fee also cannot be claimed. Okay, just should be quite straightforward. I think F also straightforward. All right. Payment of employees' hospitalization bills and medical expenses, right? But the medical coverage is obligated under WICA. Right. So in this case, right, a lot of people see medical expenses, medical bills straight away in the mind is cannot claim. Right. But read the next line, is obligated under WICA. Right. So it's claimable. It's not disallowed. Okay, because it's obligatory under WICA. Right. Then part G, okay, purchase of a hamper which was given to a loyal customer. The hamper cost $300 with a GST amount. Right. So the minute you see given, hamper lah, gifts lah, given to customer, what must be in your mind is deeming. All right. So in this case, you don't know, right? Whether, is this a claiming question? Right, sorry, this is a claiming case. This is currently is under a claiming question. So I think what you need to do is say whether is it claimable or not. All right, so actually the answer will be if it's incurred for business purpose, it's claimable. But since the gift is more than 200, they need to deem. Okay, actually you can go on like the answer to say that if the customer, they can also choose not to claim if they want to. Okay, either answers will be okay. All right, so strictly speaking, it's claimable. All right, but you need to deem. Otherwise, don't claim, so no need to deem. Right. And last but not least, payment of salary and bonuses of 50,000 to staff. Right. So in this case, salary and bonuses, they don't attract GST, so there's nothing to claim. Ken, any question on the claiming part? The next part of the question is on charging already. Right, so the exam question will be something like that. Okay, scenario, break down into claiming and charging, and then there are various sub questions. All right, each question will be ranging between 1 to 2 marks for each part of the question. Right, the first question will be a bit longer. It'll be something like this. Okay, don't have. I go on to the supplies. Right. Okay, now we'll move on to the supply leg. So supply leg, again, you need to tell me the correct classification. All right. So for the first one, sale of goods to local customer. Right. So you need to be able to tell me is a standard rated supply and what's the output tax amount. Right. So part 1 is straightforward. Local customer standard rated. Okay. The second one, sale of goods to local customer for $300,000 where the goods were delivered from China to Australia. Right, so the minute you see delivered from one place overseas to another place overseas, somehow we use the word directly here, right? Straight away in your mind, it must be out of scope supply. Okay, don't need to report in GST return. Okay, like I mentioned, it's not very easy to confuse with zero rated. Okay, so just see the origin and destination. If origin, destination are all overseas, it's out of scope. Okay, the next part of the question, you sell goods to related company, goods delivered locally. The minute you see goods delivered locally means it's standard rated already. Right, part L, receipt of dividend income. Okay, of 40,000 from overseas company. So dividend, right? We shared just now. Dividend is out of scope. Okay, dividend is passive income. It's not for any supply of goods or services. So it's out of scope. It is not exempt supply. Okay, very common people put exempt supply. It's not exempt supply. It's out of scope. Okay, part M, right? The bank deposit of 100,000 with a bank in Australia which yield an interest of this amount. Principal sum and interest were received. All right. So normally interest, if it's in a local bank, it'll be exempt supply. But interest from deposits in an overseas bank, this is what we call exempt supply that qualify for zero rating. If you put exempt supply that qualify for zero rating, correct. If you put zero rated supply only, also correct. Okay, either one is acceptable. All right. But please state the correct amount, the amount of supply. So in this case, the value of the supply is the interest amount, which is 3750. Again, commonly people will put 100,000. 100,000 is the principal sum. It is not the value of supply. At the end of the day, the consideration for this deposit is the interest. And the interest is only 3,000 plus. So this is the value of supply you need to report in GST return. Okay, it's not the principal sum. All right. Part N. Okay, sale of shares through Singapore Stock Exchange for amount of this amount, and then ABC made a gain of 30,000. All right. So this one on the flip side, right? Okay, so the minute you see shares, Singapore Stock Exchange, you should know it's exempt supply. All right. So this one usually quite straightforward, exempt supply. The tricky part is on the value. Okay, a lot of people will put 30,000 as the value of exempt supply. Wrong. Okay, for sale of shares, the value of that transaction, right, is the entire sales proceed, which is 150K. Okay, for sale of shares, we don't look at net gain or loss, right? The value of your shares, which is the 150,000. Right, so just take note. Okay, it's a bit different. The part M, the deposit, right? The principal sum, that's not a value. That's just what you're putting in only. But what you get out of it is the interest. All right. But for sale of shares, what you get out is actually 150K, because that's the value of your share. Your gain or your profit or loss is really about, this is a profit only. Remember we said GST is not based on profit. Even if ABC made a loss, right? The value of exempt supply is still 150K. Okay, and the last bit is receipt of rental income of 2,000 from a director for the lease of an unfurnished residential apartment. Okay, this one, the minute you see unfurnished resi apartment, it must be exempt supply. All right, and then in this case is 2,000 because it tell you unfurnished. So that's for question 1. Right, so the question will be quite similar lah. There won't be as many parts, right? Because this is quite long. There's quite a lot of parts. There won't be so many, right? But it gives you a good flavor lah. Something like this. Yeah. So just take note. You must tell me the correct classification, right? If you put what is all scope, right? You put zero rated, then I cannot give you the mark for that lah. At the most I can only give you some marks if you're reporting the value correctly, right? Okay, this one, right? I think you have this. Is your worksheet of as to how you would report. Let's say, for example, this is not for exam purpose, yeah. For exam purpose, you just answer like this will do. You all write a bit more lah, but just have to explain the basis and all that, right? But for this is more for, let's say if you are to prepare a GST return, all right? How would you prepare? Right, because you have many transactions, right? After you go through what's standard rated, what's not, and all that, right? This is normally how you would do it. Okay, I will give you this tag later. I'm not going to go through this, but I'm just trying to show that this is how you would do. All right, you will, for every single transaction, you will put down, okay, if it's a purchase, if it's a claiming. So they are always a couple, right? If you are claiming, you should see something in taxable purchase, that's the value of your purchase, and input tax claim. All right, taxable purchase is box 5, input tax claim is box 7, right? So when you're claiming, you must always be these two. The value no need to tie in. Like, so some people will say, then my input tax, right, must always be 8% of my taxable purchase. Need not be. All right, because sometimes it depends on whether the price inclusive or exclusive of GST, whether you use a tax fraction. Sometimes it also, because taxable purchase, you also include zero rated purchase. Just now the example of air ticket. Air ticket will go into taxable purchase, but never go into input tax. So it's not, it won't tie in. But if you are 100% local, right, all your purchases are local, then yeah, mathematically, it should be 8% lah of your taxable purchase, right? So that's for your purchase. All right, whatever that is non-taxable, you can record it in this manner. This gives you a sample template only, but I think nowadays, most people use accounting software also. Okay, then this is for all the different purchase amount just now, for all the different parts that we went through. Okay, whatever input tax that you cannot claim, like your like any disallowed expenses and all that, no need to go into GST return. You can keep track of it separately, but no need to put in GST return. Okay, so for supplies, okay, supplies usually is standard rated. Box 1, we must see the output tax in box 7. Box 6, sorry. Box 1 and 6. Okay, so for zero rated, there would not be output tax. Exam also, there's no output tax. Okay, you just put accordingly. Okay, out of scope, you don't need to report in your GST return. Okay, so that's about it. Okay, I will later send this through. That's for question 1. Okay, then we will go on to question 8.3 of your case study. All right, so this also, so the exam question has two questions lah. The first one will be something like just now. The second one will be a shorter question testing you on GST registration liability, similar to this format. Okay, I say similar to this format, not similar to the actual scenario, okay? Similar to format only. All right, so it will basically give you a company and telling you what are the different supplies that the company have, what are the different business activity. All right, it will give you the turnover. It may be the question may give you a past turnover, a retro one, or a projected one. Okay, may or may not, may give you both, may not give you both. All right. Okay, so but indeed, let's focus on this case. So in this case, you have XYZ. Okay, XYZ trades in property. Okay, buying and selling of property. XYZ also own one SP business, SP trading, which is involved in the business and selling of computer peripherals. All right, so just now this was the question someone asked earlier. Can a company own a sole proprietor? Yes, they can. Okay, nothing stopping you to own. Just have to register the sole proprietor under ACRA. I just say the sole proprietor is owned by a company instead of owned by a person. Right? Why do people do that? Usually they do that when the nature of business is quite different. Like my normal activity is do this, but actually I want to set up a sideline, I want to set up another business doing something different. So then it's more for, I think it's more for branding as well as keeping the accounts clean lah. Right? It doesn't matter. Okay, so then this one they will show you, okay, XYZ, what are the different turnover. So XYZ has commercial, has residential property, also receive bank interest from Singapore as well as overseas bank. Okay, SP trading, okay, sell computer peripherals local exported as well as directly from China to Indonesia. All right. So then you need to advise XYZ on the determining GST registration liability. Okay, so in this case, right, the first thing you must advise, the first thing you must say is, as the company who owns a SP business, they need to aggregate, right? So they need to aggregate the turnover of all the sole proprietorship, all the SP businesses, i.e. the SP trading, with its own supplies to determine liability to register. All right, then you have the retrospective and prospective view and all those things. All right, typically the meat of the question will be on the computation. All right, so you take note of the question, whether is it asking you to compute based on retrospective or prospective or both, or depending on the question, if it's only looking backward, only give you the past turnover, then by default it's a retrospective computation. All right, so what I will be looking out for is not only your final amount obviously must tally, right? Because we want you to compute the turnover. The final turnover must be correct. All right. But on top of that, I will also see whether are you putting in the correct supplies. Okay, by default, if your total is correct, you're putting in the correct supplies also, right? Then you'll be able to score full marks for that question. If let's say your total is not correct because certain things maybe you think it should be included when it shouldn't have been, that's when I will still look at all the various supplies that you include or exclude. All right. So it's important for you. What you can do, right? When you have this kind of question, right? Let's say in a table form, the first thing you should do, right, is to indicate, include, exclude, and then put what kind of supply. Okay. All right. So, like I said, the question will not be exactly the same, right? But either way, you will be expected to know. You need to be able to indicate what kind of supply, include or exclude. All right. And then that will form the basis for your computation. Okay. And you need to know that the different permutation. So for example, if retro more than 1 mil, but going forward not more than 1 mil, liable or not, or if in the past never hit 1 mil, but going forward will hit more than 1 million, liable or not. Okay, so when you answer a question on liability to register, right, you must consider both retro and prospective. Okay. Right, this last part of this question will be different if let's say XYZ does not own or trade in commercial property. Right. So just now, right, a lot of XYZ's turnover, right, is from the properties because the first part of the question say that XYZ's principal activity is in trading in property. So if you are trading in property, all your sale and lease in properties, right, will all be part of your normal trading activity, part of your normal taxable supply. You need to count in, you need to include when you compute the 1 million. But let's say you are not. Okay, for a normal business, okay, if you are not trading in properties, you're doing anything else, okay, and but then you will happen to have that one sale of property, right? Then we call this sale of capital asset, right? So just now I mentioned during the registration, the part on GST registration liability, to compute GST registration liability, we actually exclude the sale of capital asset. Right? That's like one off, you just happen to have one property, you sell already more than 1 million, it doesn't render you registrable, right? You look at your other normal business. Unless you are already in the business of trading in property, like in this case. Right? So that's why we say if XYZ does not trade in commercial property, it doesn't have to include the sale of the capital, the sale of the property, right? In its turnover. Okay, and that's about it. I think that's all. Any other questions? And that's all I have already. We quite on time. I think got 5 minutes, 10 minutes if you all want. Let me stop sharing, yeah. Okay, so the answer deck for those two questions, I will send through CPA and ask them to email you guys. But actually the answers are in the study guide lah. Right, in the study guide as well. I just drafted in point form only in the slides. Okay. Does anyone have any questions? Let me see. Okay. Registration is on 1st Jan or August 21 is still within 6 months. Are you referring to any question? Wait, Can I come back to that? Wait,
Yeah, I think it's earlier slide.
Let me see. The first question, is it?
Slide 81, I think.
Oh, okay. Sorry. So thanks for pointing it out. Yeah, I think there is a typo there. I think she's referring to this. Let me reshare. Thanks for highlighting. Yeah, I think if I'm right, you are referring to part B, right, of this slide. Okay, because the furniture was purchased in 10 August 21, but registration date is on 1st Jan, so it's still within 6 months. Let me change this, yeah. But the answer doesn't change. Yeah, it's still within 6 months. Okay, the goods is still on hand, still claimable, right? But it should be within 6 months. Okay, thanks for pointing it out. Okay. Next question for Manling. Why bank interest from Hong Kong is not included in computing the annual taxable turnover? Okay, so bank interest from Hong Kong are exempt supplies that would qualify for zero rating. Wait, I need to go back to the main slides. Okay, so normally zero rated supply, we take it in, right? We will take it in to compute the GST registration threshold, except for, wait, let me find. Okay, except for exempt supply that qualify for zero rating. Okay. Okay, can you all see this slide? This was my slide just now, slide 70 of my main deck, right? So when we compute annual taxable turnover, this is under the law lah, okay? So it includes standard rated and most zero rated supply. All your normal zero rated supply, we will include to count the 1 million. What we exclude is exempt supply, that one you all know, okay, as well as exempt supply that qualify for zero rating. Okay, because actually underlying, okay, let's say the bank interest from overseas bank, right? Underlying, it is still exempt supply. It's just that we allow it to be reported as zero rated supply, but it doesn't make it a zero rated supply lah. So that's the technical answer to it. So yes, you exclude such things. Only this. Other zero rated supply, all you will include. You only exclude exempt supply that qualify for zero rating. Right? Thanks, Claire. Okay, did I do a summary of the topics that will be examinable? All right. So the summary of the topics that are examinable, right, will be what was covered in the 2 case study that we went through earlier, right? Meaning, okay, I cannot be giving you also so much details lah. We will be the things that you need to focus on. Okay, will be input tax claim. You need to know what are the conditions to claim input tax, and then what are the disallowed expenses. You know, the things that we will not allow the input tax claim. You need to know those very well. You need to know the pre-registration. Yeah, pre-registration rules. All right. Just roughly the 6 months, not 6 months. What happened if, let's say, some of the goods were consumed or onward supply before registration? All right. That's for the input tax. Then you need to know the charging side, right? You need to know what are the different types of supply, right? When is it a standard rated? When is it zero rated? When is it a scope and exempt? Right? So that one you need to know lah. All right, and then the last bit will be on registration liability. So this ties in with based on your category of supply, you need to know how you compute registration liability for both retro and prospective. All right, I think just on GST rate change, I mentioned a bit. You need to know roughly the rule. Simple scenario lah, right? Just looking at payment, invoice, date, and when goods are delivered or services performed, right? Roughly whether is it a 7% or 8%, right? That's all we can test in the exam. Things like reverse charge, OVR not tested. What else? I can't really remember. Yeah, the basic concepts, the very, very fundamental, that kind, those are fundamental concepts that are good for you to know, but we won't be testing those specifically, right? We won't be testing on international service. We won't be testing on partial exemption rules, right? Right, and related to Claire's next question, yes, the exam only have 2 big questions. This module is total of 20 marks, right? There are two questions lah, but each question got multiple parts to it. MES not tested, right? Claire's question, do you need to do a GST return or just short answer? No need to do GST return. Just short answer will do with some computation, simple computation. No need to memorize the law and all that. No need, if you can quote it, good. If you don't, it's okay. Yeah, it doesn't really matter. All right. Yep. I think Tax Academy already give you guys the attendance link. Yep, and it's also 1 o'clock already. Yep. Any last question? 2 minutes. Yeah, but if you all got any questions after this, I think or anything you want to clarify, you all always can send through CPA lah, and then they will send it over to me as well. Yeah. Right. Exam can write in point form is fine. Just make sure it's readable and all that. No need to write very long story. See how many marks the question. Right. If question is only 1-2 marks, no need to write so long. Okay. Yeah, and please make sure you attempt every single question. I think it's quite common, like, sometimes you don't have time, you're rushing through. You may leave out certain questions, totally, but don't waste the marks lah. Even if sometimes you just write 0 rated exam and all that, you still get some marks. Pause question: Citibank interest is exam or 0 rated? If it's local bank, exam. If it's local Citibank, is exam. You put in a local bank account here. If it's from the Citibank overseas bank one, you open the account overseas, then it's exam supply that qualify for 0 rating, which means you can just reply as 0 rated. Okay, can. Other than that, I think we are done. I will hang around for 5-10 minutes in case you all have any questions left. But otherwise, please, fill up those links. Yep. And I think that's it. Thank you so much, everybody. Good luck for your exams. Have a good weekend. Thank you.